On this Friday, January 3rd, welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Maddie Mills this morning. Let's get to the three things that you need to know today.
First up, U.S. stocks looking to snap those 5 days of losses. Equity futures trading in the green, finally, after stocks saw their worst stretch of declines dating back to April of last year. It's been a volatile week for the market. Looks like investors will miss out on that Santa Claus rally this year. But as a reminder, we also missed out last year, still saw gains of over 20% on the S&P 500. And it's not just stocks sputtering into the new year. Bitcoin also seeing volatility to kick off the year, with BlackRock's Bitcoin ETF seeing record outflows in Thursday's session.
Plus, President Biden has decided to block the sale of U.S. steel to Japan's Nippon Steel. The White House making the announcement this morning, with the president making the formal decision after the case was referred to him by a U.S. Security Review panel. Shares of the company taking a hit on the news after the $14.1 billion deal faced months of vocal opposition and raised questions over the future of the industrial giant.
And the House of Representatives will be sworn in today and will also vote on whether current Speaker Mike Johnson can keep his gavel after a year-end budget deal that divided conservatives. President-elect Donald Trump previously gave Johnson his complete, total endorsement, but Johnson will have to navigate factions within his own party, where the GOP won a 4-vote majority in November.
Breaking news this morning, President Biden has officially blocked Nippon Steel's $14.9 billion deal and the takeover of U.S. Steel. The White House announcing the decision today, citing national security concerns. This after it was referred to the president on December 23rd when the Committee on Foreign Investment in the U.S., known as CFIUS, failed to reach a consensus. Joining us now, Josh Sporus, who is the CRU North American Steel Analyst. Great to have you here with us. All right, $14 billion plus deal now essentially blocked by Biden. What comes next here, especially as this is precedent setting? We hadn't seen but a handful plus maybe two fingers of deals essentially make it to this point as reviewed by CFIUS and then referred to the president in previous administrations.
Right. Yeah. Well, good morning, and thank you for having me on. Yeah, essentially, this is it's very interesting from a number of points. I mean, the first point is U.S. Steel is not the largest steelmaker in the United States, so it's more so name, and it's been just a very highly politicized process.
Well, it has been politicized, and because of that, I want to pull up the statement we got from President Biden about the blocking of the deal this morning. He said, quote, "The acquisition would place one of America's largest steel producers under foreign control and create risk for our national security and our critical supply chains." And here you can see he talks about the commitment to national security in the executive branch on your screen. Is this about national security? Is it about foreign investment?
No, it's more so. It's just been highly politicized. So you have the potential. You had the potential for Nippon Steel, one of the largest steelmakers in the world, the most technologically advanced steelmaker in the world, was going to invest billions of dollars in the United States. And now, what if this truly is blocked? And this is the final chapter. You have U.S. Steel, as previously said, as they bring on new capacity in Arkansas, which is starting to ramp up here already, they would shut down another facility. So very likely this ends up to cut out some union jobs instead of investing in them.
That's exactly where I wanted to go, Josh. How many jobs could potentially be impacted by this, and when might we see that in that key non-farm payrolls report? Well,
it's potentially thousands of jobs, and we very well may see a warn notice from U.S. Steel as soon as today. I would imagine it takes a little longer, but you would have the warn notice. There's probably a period before they actually happen. So it could be the first quarter. It may more likely be the second quarter.
Josh, I wonder from your examination, especially as we're just weeks away from the changing of the guards in Washington, D.C., when we think about some of the investments in this industry that President Biden was talking about within their statement and really looking through some of the what they call record investments in manufacturing, more than 100 new steel and iron mills opened since Biden took office, where now we may see more investments in the same industry, but also with some other perhaps inclinations or ramifications from those countries and entities making those investments, as Trump has said, President-elect Trump has essentially kind of greenlit fast-tracking some of those approvals once we do see other entities and nations start to make their own investments towards the infrastructure within the U.S.
Right. That's where this may not be the full end of the chapter, where, because we're almost between administrations. You have President Trump just a couple of weeks ago said that anybody investing $1 billion will get expedited. So it just gets a little bit odd when the government's invested billions of dollars in foreign chip producers to come to the United States to bring their technology here, that we're not doing that same for steel. So I think there's the opportunity that under, when President Trump comes back into office, he seems more attuned to making deals, and he's been very visible to encourage investment in the United States. So we may see some opportunity come for Nippon to come back into the U.S. So they're already here with a number of facilities, but potentially they could come with a new deal here for U.S. Steel, or potentially even a JV for some of their assets.
Well, in that case, if you were seeing even more of their own capacity that comes online in the U.S., would that then further weaken U.S. Steel?
Well, U.S. Steel is actually in a really good position. They have billions in cash. They've been profitable the last few years. Prices in the U.S., though, for steel have fallen throughout all of 2024. Profits at steel mills have slowed. I think only Cleveland-Cliffs is the one that has seen negative earnings every quarter. But U.S. Steel is still is doing well, and they're actually set to do even better as this Big River 2 steel mill comes on. It's a 3 million ton mill that is much more variable cost based. So it's an electric arc furnace, and allows them to be much more flexible in the market and very profitable still at today's price levels versus what their typical assets are, being a blast furnace mill.
If this deal does still have potential, as you say, what could that timeline potentially look like?
Certainly, there's the immediate effect of Nippon previously talked about legal action, so that would be very immediate. But more likely, it's under a President Trump, and it would be over the next couple of months to get this type of investment deal and negotiations in the works.
Josh, thanks so much for taking the time here with us this morning on this breaking news, giving us some of the insights and analysis. Appreciate it.
Yeah, thanks for having me on.
Certainly. A Santa sell-off coming to the markets to start the year, with the stocks falling for the last 5 days in 2024 and the first 2 days here. And we'll see exactly where things end here today in 2025. But the longest losing streak since April, we should note, of 2024. However, our next guest says that the bull market is alive and well, and if you don't buy now, that it could be an expensive mess. Joining us now is Callie Cox, Ritholtz Wealth Management's Chief Market Strategist. Great to have you here with us, and Happy New Year to you, Callie. First and foremost, as you think about even the valuations right now for some of the most overcrowded trades, which is essentially long Mag 7, how is it that now could be the time to buy the dip versus kind of waiting to see how things play out over these next few weeks going into the inauguration?
First of all, Happy New Year. It seems like we're in a new year, but not much has changed. That's the way it goes, Brad and Maddie. Well, you're right. The market looks pretty expensive here, but if you dig underneath the surface, there still are pockets of value, Brad. And that's what I'm talking about when I say that this market still has legs to run on. Of course, the economy is doing pretty well at the moment. There are some signs of weakness. If you look from a broad bird's eye view, corporate America is in a good position. The U.S. consumer is in a good position. And if there are pockets of value in the market, especially outside of tech, then I'd say that that's a good time to step in, especially if we see prices continue to decline from here. Because everybody knows the classic investing advice is buy low, sell high.
Where do you find that value, Callie, and how do you suss out the value of value stocks versus the risk of those stocks?
Well, that's a good question, right? Because the other argument you could make is that value hasn't worked in a really long time, Maddie. And I mean, that's also true. I mean, tech is dominant for a reason. But right now, you see profits broadening out across the sector. I still think some rate-sensitive sectors look interesting right now, although I'm getting a little less excited about them now that the Fed is committed to keeping rates somewhat high for a bit, and inflation concerns are coming back.
All these things considered, as we're thinking about some of the core metrics that analysts are going to be grading the companies who are going to talk about macroeconomic conditions, that are going to talk about the changing of the, who's occupying the seat at 1600 Pennsylvania Avenue as we begin the earnings season. S&P is still looking for calendar year, or FactSet is looking for S&P 500 calendar year 2025 earnings growth of 15% here. What would need to happen in order for us to see that come to fruition over this calendar year?
Yeah, well, let me note, first of all, 15% earnings growth in a year is incredibly good. That would be the best year since 2018. And I look at Bloomberg estimates, but Bloomberg analysts surveyed by Bloomberg see profit growth across all 11 sectors in the S&P 500, something that also hasn't happened in several years. So Wall Street expects another good year for corporate America. And I think you see that driven by, an increase of sales and continued management of costs. But you could also see a little bit of cost management through productivity as well, which is something that I'm watching, Brad. It's not something that you'll see show up in an earnings report, but something that you'll hear management teams talk about. I will put a caveat in there, though. We have a lot of policy speculation right now. We're not sure, what will be enacted and how quickly it will be enacted. So that's still a really big question mark. I expect management teams to start talking about that in this next earnings season. But for now, I'm not really factoring that into how I think about markets. It's still a question mark.
Well, I do want to talk a bit about that productivity boost that we've seen, particularly since 2020, Callie, and you do such great work on this exact topic. But I guess I wonder what the tipping point is for when productivity is good for stocks because it helps companies maybe cut costs, cut back on labor, versus when that becomes a macro problem where there's too much cost cutting in the form of cutting jobs, and then it creates an issue for the macro picture.
I think that's a big question that so many people on Wall Street are trying to answer right now, Maddie. And we can start with the fact that productivity historically has been really good for the economy and the stock market. It shows that technological innovation is sound, it's growing, and that both workers and companies are getting what they want. Workers are getting higher wages, stronger skill sets, and companies are getting more output. And through more output, they're getting lower costs per unit produced. Of course, the economy has changed a lot in the past few decades. We're more of a service-based economy. Productivity gets a little weird there because it's hard to measure for example, the amount of haircuts given at a salon or something. It's more of a manufacturing type phenomenon. We also have this question about AI, and I know that there's a lot of worry around, what AI could mean for the workforce. But right now, there's not a lot of, real evidence to back up the fact that it could cut into the number of jobs available. It could be a productivity boosting tool, and that could actually allow companies to grow their ability to produce or to have more people on staff. So still a big question mark for me. I think that that's a really interesting thought exercise, but definitely one that a lot of people are stressing out about these days.
All right, with the absence of the Santa Claus rally, does that kind of yield any prevailing thought about a unsung outperformer that you believe is best positioned in terms of an opportunity scope here for 2025?
Well, tech has led the fall that we've seen during the Santa Claus rally period. And I'm not so shocked by that. I mean, tech, like I said, has been a dominant story in U.S. markets, and for good reason. But a lot of times when you see market weakness, you see those high flyers lead on the way down. And we've been telling our clients to think about balance in their portfolios. Think about how far tech has run, maybe consider taking some profits there, rotating into more unloved sectors. And right now you're seeing one of those, big case studies for why that's important. I don't know how far the market falls from here, Brad. I certainly don't assign too much weight to seasonal patterns. Just because the market is falling during the Santa Claus rally period doesn't mean that we're doomed. But at the same time, I think it is a really good reminder to look for that balance in your portfolio and understand that this bull market hasn't benefited all sectors, and that could be an opportunity for you.
All right, Callie Cox, always a joy to speak with you. Happy New Year.
Happy New Year.
Another stock we're keeping our eye on this morning is Boeing, releasing an updated safety and quality plan nearly 1 year after that door plug blew out on an Alaskan Airlines flight. Boeing's plan focuses on 4 areas: investing in workforce training, simplifying plans and processes, eliminating defects, and elevating safety and quality culture. Boeing says it continues to cooperate with the National Transportation Safety Board and the FAA and their investigations of that Alaska Airlines flight, which again we are approaching the 1-year anniversary of. You can see off the back of this news, the stock down just about 0.4%. I think it's really interesting to point to some of these quality checks that Boeing is announcing today, Brad, because this is something that obviously was at the top of Kelly Ortberg's to-do list when he came in as the new CEO. And the culture around flagging safety concerns is something he talked about as a key importance early on, and the idea of not creating a culture of punishment for whistleblowers that do come forward. I'm going to be interested to see how successful they can be in changing that culture. That's a really big shift that has to happen when he's kind of new to the job.
Yeah. Well, unfortunately, that's going to be a massive shift that needs to take place here, considering some of those whistleblowers, unfortunately, have been found, some of them dead, after they were ready to come forward with some of the complaints here, whether that it's, at certain points in the production. At the end of the day, this is, and one of the things that I was thinking about more broadly coming into this and the anniversary of this is that it's now what's old is new again, and that when the Boeing 737 MAX first had its issues, Trump was in office, and Trump was very, very vocal about what Boeing would need to do thereafter. He even talked about, hey, just scrapping the name entirely and rebranding it. We'll see what Boeing has to do ultimately to make sure that they're able to not just get back in the good graces of the manufacturing and making sure that they're also bringing on Spirit Aerosystems and integrating that so that they see the efficiencies that are necessary by bringing that back under their own manufacturing realm, but also that the airline customers are confident enough to place large orders for years out from now that won't be delivered upon for several years, maybe even a decade, because of the backlog that is now stacked up as well here. So it's both on the airline purchaser side, but also on the customer and the flying public side too, because the airlines are going to take perhaps some of their cues from those customers. And we've had, of course, some of the CEOs who have a more outsized exposure to the Boeing 737 MAX, like a Bob Jordan over at Southwest Airlines. We've had them on to discuss, and many of them are confident in Kelly Ortberg. So this is going to be a critical, I think, next 2 quarters here are key for Boeing and really telling the street and analysts, but also their core customers, that there's been a major shift here.
Really great point too, Brad, in terms of the executive search story there. That was such a huge thing that we were looking at, and I know that you've talked to a lot of the airline CEOs, so hearing them echo that confidence is really key here as we take a look at Boeing and they start to kind of measure out the quality check success moving forward in their factories. Coming up on Morning Brief, we're going to count you down to the opening bell on Wall Street. Stocks looking to snap those 5 days of losses. We'll also break down the latest delivery numbers from automakers as Rivian beats production estimates. You can see the stock up over 5%. And ServiceNow getting a big upgrade on Wall Street. We'll bring you the top analyst calls that you need to know to start your day. All that and more coming up on Morning Brief.
Bitcoin reached new highs in 2024, hitting the $100,000 mark in mid-December. It's since pulled back from its highs. BlackRock's Bitcoin ETF saw record outflows on Thursday. So what's ahead, for Bitcoin and crypto in the year to come? We've got Andy Baer, who is the CoinDesk Indices Managing Director, joining us in studio. Great to see you. Happy New Year to you.
Happy New Year.
All right, so coming off of a all-time high that we saw set in 2024 at the very end here, what lies ahead for crypto? What's going to be the major, dare I say, catalyst that really takes this market by storm?
Let's remember how 2024 was a blockbuster year. Got so much done. The ETFs, the interest rate cycle beginning to
the halving happened,
and then the election. So, but all that performance came in two clumps. In the first quarter, we had the ETF mania, and that drove performance. We had a really slow summer. And then we had between September 18th and December 18th, between the two Fed meetings, that's when everything returned. The election was during that period. So the first thing that, looking ahead, performance like that's going to come in clumps again, right? Crypto tends to move in these kind of momentum cycles. And so we have to be patient during the quiet times. We have to get excited. So for most investors, you have to think really long term. But let's just remember there's going to be some great periods and there's going to be some quiet periods coming ahead. We just have to be prepared for that.
Talk to me about this question of froth in the market, and I know you're already laughing, but so many of the investors we talk to say once Bitcoin hits 150, 200K, that's an indication that we're about to have a market sell-off because there's just way too much risk appetite. How do you rate that call?
Today is the 16th anniversary of the Genesis block. So January 3rd, 2009. So we have a very young asset class here. And we have these four areas of adoption momentum that started to get traction last year. We have sovereign, right, for strategic reserves. Yeah. We have corporate, right, with pitches being made to Microsoft. We have institutional. We still don't have a broad pension fund or insurance company holdings, of Bitcoin. We have an advisory and retail, which we've had some retail, but advisory is still early stages. So the adoption momentum, when you think ahead, is just getting off to a start. And the dialogue change between this time last year and today has been huge. So you can't really look at Bitcoin and think of it as something that has a valuation cycle like a 500-year-old asset. It's still brand new. Adoption momentum for Bitcoin is going to do two things. It's going to continue to support a medium to long-term price. And it'll also, over time, we believe, help to dampen volatility.
What are the keys to regulation that need to come forward, even after we saw the broader crypto landscape really kind of cheer some of the cabinet picks from President Trump, President-elect Trump? So
for Bitcoin, doesn't really need that much more, right? We have pretty solid CFTC regulatory framework, futures, ETFs, options on ETFs. Really all you need more is for people to get on board and to get educated. For the rest of the market, think about stable coins, right? There's 200 billion of stable coins right now in total value locked. Some are predicting that might double this year.
Isn't that a net knock, though, to Bitcoin, to Ethereum, if it's stable coins that get more of the regulation?
Where do those stable coins trade? They need a blockchain, right? Tether, Circle, they're not blockchains. They're tokens that sit on Ethereum. They may sit on Solana. They need blockchains, right? One of the reasons we think we saw Ethereum rise so much after the election is the use cases are going to come in. If stablecoin legislation gets passed this year, which many think it will, those stablecoins have to trade and settle somewhere. So this is the beginning of the kind of smart contract platform rally. Now, many people think a lot of that's going to remain on Ethereum, and that's a safe place to be. But there's a bunch of layer ones, right? And so investors aren't really sure. Solana was really popular over the past couple of years for ETFs and for meme coins. That did a lot better. So investors have to think about where all of these things are going to trade, what kind of tokens and projects are going to support them, what's going to happen in DeFi with Uniswap and Chainlink. There's just a lot of things. And the last time we were on, we were talking about how Ripple and Stellar were taking off after the election. So right now, investors have a conundrum. I'm sure you're getting the same questions I was getting over the holidays. What crypto should I buy?
Everybody.
Right? Everybody. Not just Bitcoin anymore. People should, look into Bitcoin and have it as a macro asset. The rest, it's a pretty complicated picture. We just know growth is ahead. As an indexer, of course, we like CoinDesk 20, which was up 88% last year, over 20 tokens. But the top winners there were ones that very few people had on their bingo cards, right? Very few people thought that Ripple would be the #1 performer last year. So it's going to be hard to plot exactly. Token picking and timing are going to be difficult, but with the regulatory tailwinds and the adoption momentum, we think the whole space is going to do super well.
Final 30 seconds. These outflows in the BlackRock Bitcoin ETF, 300 million pulled on Thursday, the most since the launch. Much ado about nothing?
Well, I don't know. It's hard to tell. There's a lot of these are very big and very liquid ETFs. So I think inflows and outflows are easy to look at. Might have been tax related. Might have been profit taking in the beginning of January. Who knows? And a lot of these ETFs are used in arbitrage strategies versus futures. They're not just necessarily buy and hold. I tend maybe to get a little bit nervous about day-to-day inflows and outflows. Our trend indicators are neutral for Bitcoin and Ether right now, but we're just not in one of these big rally periods, right? We're kind of taking a break since December 18th. During the next momentum rally, we'll see what happens, but we're pretty sure it's going to be a broad rally.
All right, Andy, optimism. Thank you so much for bringing
Thanks.
that to us. We appreciate it. Well, with all your markets action ahead, stay tuned for more. You're watching Morning Brief.
That is the opening bell at the New York Stock Exchange and at the Nasdaq that you're seeing there on your screen. We've got some great bell ringers there. Over at the New York Stock Exchange, I think you've got the professional bull riders here. It's been a while since I've been, well, on a mechanical bull at least. That last time was in Nashville, Tennessee here, of course, as you must do, when in Rome. Anyway, that's the opening bell. We got some great bell ringers, as we mentioned here. We're kicking off today's trading activity on this Friday. And as I'm taking a look at some of the major averages here, looks like we're beginning today in positive territory. I've got the Wi-Fi Interactive fired up here on my screen. We've got some major averages here on your screen. The Dow Jones Industrial Average seeing gains of about 0.5%, about the same on a percentage basis for the S&P 500. And the Nasdaq Composite, you're seeing that higher by 0.6%. I want to fire up our Wi-Fi Interactive here just to take you into some of the heat maps that we're tracking here on the day as well here, and I'll toggle on over to the 11 S&P 500 sectors. We'll take a look at things there as we always do to kick off the trading session. As of right now, we're led by communication services. It's up by about 0.7%, and bringing up the caboose, but still positive, is real estate. So green across the screen. We like that to start the day here. The Nasdaq Composite, taking a look at the Nasdaq 100, I should say here. If we were to try and fit more than 3,000 companies on here, it would be a doozy. But we got 100 for you here on the screen. Apple right now, that's down by about 0.4% at this point in time. You're also seeing a little bit of a move higher here for NVIDIA, up by about 2% to start the day. Not too shabby, NVIDIA and Jensen. Microsoft, MSFT is the ticker symbol there. You're seeing that higher by about 0.5%. Also seeing some gains across Alphabet, Amazon, and Meta as well. And we'll take a look at the Dow Jones Industrial Average here. 30 components here. We got them fired up. Really just 3 red spots right now. It's in the form of 3M. Perhaps you were using a lot of that tape to tape some presents that you were giving, gifts that you were giving over the holidays. Anyway, call them down right now by about 0.2%. Also, we mentioned Apple earlier, but it seems like 28 out of the 30 Dow components right now in positive territory, led by, yep, you guessed it, NVIDIA. We'd mentioned that earlier. It seems like financials certainly have been one of the major calls coming into the start of 2025 here. JPM, that's leading the pack here out of the gate this morning, up by about 1.5% as well. And then just lastly here, we were talking a lot about crypto a moment ago here. So let's just take a quick look at what cryptocurrencies are doing here on the day. Bitcoin, of course, this is a market that never closes, but it's higher by about 0.5% over the past 24-hour period. We'll round that out to. Let's give you a good 5-day look at it. How do we feel about that? We feel pretty good. We're up by about 3.94% as of this point in time. All right. All that said, we got a lot of green on the crypto heat map. With that, let me toss it on over to Maddie for our chart of the day.
Thanks so much, Brad. Yeah, it's time now for our chart of the day. I want to take a look at how the market tends to perform after historic gains. So over the past 2 years, as a reminder, we've seen 50% of a run to the upside in the broader market. Bank of America crunching the numbers, taking a look historically at how the market performs after returns of 40% to 50% gains in 2 years. And if you take a look at the belly of this curve, it looks like what's most likely to happen, if you look at a historic perspective, is a little bit of moderation. You tend to get a moderation after big gains. About 25% of the time you get gains of 0 to 10%, so that wouldn't be too bad after we've already been in such a bull run. The other most likely scenario is a decline, though, of either 10% or just at the flat line. And then you can see there, the next most likely is even more gains to the upside of 10 to 20%, and it goes down from there. I think what's really interesting to note here is this idea that momentum kind of begets momentum. You need some sort of external factor to slow the market down. So what could that be for this year? We're already starting to get a little bit of an indication of that slowdown, right? We had that sell-off heading into the start of this year. Now some analysts saying that that slowdown into year-end indicates a potentially soft January. And then you've got the technical phrase, so goes January, so goes the year. So as you can see, all of these trends kind of build off of one another. The question will be whether we get any external factors that drive the market higher. Do we continue to get more Fed cutting next year if some softness in the labor market starts to come in, or heck, if inflation starts to go down? Wouldn't that be nice? We could also see some of the Trump administration's policies potentially putting pressure on the market with things like tariffs, for example. All of those known unknowns potentially being the deciding factor for where the market falls next year. But more broadly, when you look at history, just given the run-up that we've had, 40 to 50% gains over the last couple of years, that tends to lead to a moderated market moving forward here.
All right, excellent stuff. Maddie, appreciate it. Time now for today's strategy session. Historical data pointing to the potential for a 10% sell-off for stocks in the new year. Joining us now to break down the data and the call here is Larry Tentarelli, who is the Blue Chip Daily Trend Report Chief Technical Strategist here. Why are the technicals casting some cold water out the gates here, Larry?
Well, thank you for having me on. Historically, the first quarter of year one of the presidential cycle it's a little bit weaker. It's the second weakest quarter in the presidential cycle. So we're seeing some chop here over the past few days, some volatility over the past 5 days. So some seasonal weakness into January, first year of the presidential cycle, is not uncommon.
It's not necessarily uncommon, but we also have a lot of potential policy positions that could impact that. How are you rating some of that potential change here, if at all, Larry?
I think the biggest move that we're seeing right now is a strong breakout in the U.S. dollar over the past few weeks. We've seen a breakout in bond yields. Ever since the Fed cut rates, bond yields have pretty much gone straight up. So I think the market's anticipating some policy changes to a stronger dollar, maybe higher bond yields. And I think that's creating some headwinds for stocks, but I don't think it's going to derail the bull market.
Talk to me a little bit more about that. We've got currencies as a potential headwind to equities. We also have yields as a potential headwind to equities. You just said that you don't necessarily think that's going to be a huge deal moving forward, but at what point does that risk tip over into something that is a little bit more tangible?
The big number for bond yields is 5% on the 10-year U.S. Treasury. I think we're right around 4.54. So if for some reason the 10-year breaks out over 5%, then I think the markets would have to adjust lower to those higher bond yields. I don't see it as of yet, but that 5% line, that's the benchmark.
You know, as we were looking at some of the outperformers that had really driven the markets last year, and two of them, Mag 7 names that are seeing a little bit of retracement here over the course of what should have been the Santa Claus rally. We didn't really see that. And the two names that really come to mind here are Apple and Tesla. For those two names and the pullbacks that we have seen, and what that could correlate when you have two outperformers like that, now seeing a little bit of a retracement to begin the year, what does that spell out for what the rest of the market could have to endure as well?
So what we're seeing with both of those stocks, they both had big breakout moves. So Apple and Tesla both made new all-time highs. With Tesla, the stock actually doubled. So Tesla went from the 240s or so to 485, 487. So it's a sharp pullback in Tesla right now. As far as the charts go, it's still trading over the 50-day moving average. So is Apple. So I think it's a constructive pullback. But with Tesla, you are going to see, I think, a lot more volatility. They missed their delivery number yesterday, but I'm long Tesla and I'm still bullish on it. But I do expect some volatility, maybe over 350 to 360.
At what point do pullbacks become unconstructive? And I'm thinking about, of course, what a lot of people were watching going into the end of the year, which really was NVIDIA and some of the volatility and the sputtering that started to take place there. There's so much concentration in these kind of long Mag 7 trades, and investors are trying to get ahead of any sharper pullback, which actually could bring in some buy on the dippers that are out there just waiting for it as well.
Right. So I use moving averages quite a bit. So the 50-day moving average is pretty widely used in the industry. And as long as the stock stays over the rising 50-day, then it's a bullish intermediate term uptrend. So you've got that with the Nasdaq 100, Apple, Tesla, Meta's trying to break out. So what we're seeing right now, we are seeing a pullback and we're seeing some consolidation. But as you said earlier, we're coming off back-to-back 20% plus years in the S&P 500. So historically, after that, you do tend to see slightly more muted returns, closer to the 8 to 10% range or so. But I am a buy the dipper crowd if we get any types of pullbacks, because if you look at the weekly charts, the weekly uptrends are intact.
I want to grab you with one more question before we head out here, because you do note kind of the potential of that pullback of 10% for the S&P 500 in 2025. What do you think would cause that?
So I think the biggest thing would be if there was a really strong breakout in bond yields, if there was a really strong breakout in the dollar. Obviously, the market's watching the economy, so if there was a recession, which that's not my base case view, and I'm bullish overall. So my year-end price target for the S&P is 65.50, which is about 12% higher from here. But historically, that first year of the presidential cycle does tend to be a bit volatile, and the S&P averages 10% pullback every year. So we haven't really had a full 10% pullback going back to 2023. So I'm not bearish. I do know that we could see some volatility, but I do think that any pullbacks will turn out to be viable.
All right, Larry, thanks for playing along with my bad English, but good colloquialism and buy on the dippers out there. Buyers on the dip would be the correct
I
word.
actually like that. I'm going to use I like that term. That's great.
We'll coin it together and revenue share on it. Appreciate it, Larry.
Excellent.
Thanks. All your markets action ahead. Stay tuned. And as we head to break, let's take a look at shares of U.S. Steel. They are falling at the open after President Biden blocked the takeover. He said in a statement, "I'm taking action to block this deal. Solemn responsibility as president to ensure that now and long into the future, America has strong domestically owned and operated steel industry that continues to power national sources of strength at home and abroad." Of course, the statement does go on. This was recommended by the president to CFIUS to block the deal. That's exactly what came forward. Highly anticipated, and also was echoed in sentiment by President-elect Trump. So one way or another, it was more likely than not that this deal would be blocked. Larger question marks going forward as to what this means for U.S. Steel, as well as Nippon's investments in the U.S. as well, more broadly here. We've got much more on this, and we'll continue to track the ticker symbol throughout the rest of today's trading session.
Rivian shares rising as much as 13% today after the company reported production for the fourth quarter that beat the average analyst estimate. Joining us now with more, we've got Tom Narayan, RBC Capital Markets Global Autos Analyst. Tom, great to have you on. So Rivian, surprise to the upside, huge win for the stock here. Very different story for Tesla yesterday, missing on the street's average estimate, and then we saw a dip in the stock. What do you make of the bifurcation in those two stories?
I think it's both of those maybe overanalyzed a little too much. For the Rivian one, we knew, the company told us that Q4 was going to be stronger than Q3. They had a supply issue in Q3. The Q4 delivery number was actually consistent with their guidance. And with Tesla, yeah, it did come in a little below where consensus was. It actually was in line with our number. I think the buy side was expecting a stronger number. There was an expectation of a pull forward of demand ahead of Trump potentially cutting IRA credits and tariffs and all of that. Maybe that pull forward didn't happen as much as people thought, but it was still a solid number. So I think both of these numbers are probably creating stock reactions that are more magnified based on where both of the stocks were trading into those events, as opposed to something more structural to take away from them.
Yeah, it seems like Tesla's trimming some of the losses that it's seen yesterday here. Of course, there was a more outsized move that we had seen just after the print came out here. If you were to really kind of read through, though, the production and delivery numbers that came through from Tesla and to the best correlation, kind of draw some conclusion about what this means for margins going forward, especially as we've already come off of some of the most margin-friendly periods for the company. What do investors need to know, and what is the setup kind of going into this calendar year, especially knowing some of the roll-off of those EV credits that are anticipated?
Yeah, that's really the question that folks should focus on is where will margins go? I think Q4 margins, they may not be as good as Q3, to your point. Remember, Q3 benefited from deferred revenue from FSD. They said that's not going to come back in Q4, so folks should understand that there could be some headwinds. There was also discounting, right, to push some of those volumes. So, yeah, Q4 margins may come in below. I mean, whether or not folks like me lower their numbers, I think consensus is a little bit high into the earnings print. That could be some downward pressure into earnings. But as we look into this year, 2025, the big thing folks will be looking for on the volume front will be this new car, right? Whatever it's called, Model Q, Model 2. They say this will be completely different from the 3 and the Y for the first time in several years, and it could be priced below $30,000. Consumers say time and time again, the headwind of buying an EV is not charging infrastructure, it's pricing. If you come in with a lower price car that people like, maybe it looks like the Cybercab, something completely different, that could reinvigorate demand. That's, I think, what folks are looking at. And on the margin front, there could be some pressure there, but they also sell energy storage, which is coming in at higher margins. So that could be an important offset.
Well, Tom, it sounds like you're thinking about lowering your price target. Are you in the camp that the street is a little too optimistic?
No, I mean, my price target is where it is. It's based on kind of a conservative look of non-auto related things, to be quite honest. It's things like autonomy, FSD, robotaxi. My upside price target, my upside value is above where the stock is trading nicely. And that incorporates, something very reasonable for autonomy. I don't really value much for the humanoid robot, which could be significant. So I think folks looking at price targets a little too much may miss what's really happening here. The stock doesn't really trade on, price targets and things. It trades on narrative. It trades on headlines and things that are more tectonic and big picture in nature.
Yeah, as a direct-to-consumer entertainment viewer who just watched Subservience, I am not giddy at all about humanoid robots, the same as you, Tom. So it sounds like we're in the same camp there. Just more largely here, as you think about some of the investments that need to take place that Tesla has already put forward that need to come to fruition this year, what is that perhaps kind of key pillars of the trade that investors need to see in order for Tesla to live up to its expectations? And at what point does the street need to reassess some of those expectations?
Yeah, certainly. Look, the stock has had quite a run since the election. So 35%, pulled back a little yesterday on the delivery, quote unquote, miss. So you see what's happening there. So yeah, I mean, expectations are very high, but there could be things that still keep the stock moving. Notably, what if they cut the price of FSD to $50 a month, let's just say, from $100? That expands its take rate substantially. People see how incredible this product is. It helps the multiple re-rate. That's just one example. What if Model Q or 2 or this new car comes out and deliveries are much bigger than where consensus is. Consensus only has like low double-digit growth. What if it's higher than that? There are reasons to get excited on the stock. There could be some headlines like deregulation of self-driving, things of that nature could help the stock. This is a volatile one, right? It pulls back and there could be more pressure, but then, folks usually come in on these pullbacks and support the stock. And there are things that could happen in 25 that could support it moving further.
Well, one of those things is Elon Musk's proximity to the incoming president, Tom. And I know you've talked about the regulatory risks for Tesla moving forward, but does Musk as, first buddy outweigh any of those regulatory risks?
Yeah, I mean, obviously this has an impact, right? It's hard to quantify from my perspective as an analyst. We've seen what the stock has done. And we've seen headlines like, that potentially the Trump administration looking at a framework for self-driving vehicles, which is a positive. So, look, it has an impact. But at the end of the day, we think what really will drive things are things that the company can control, not necessarily what happens outside of that. The FSD technology is real, regardless of who's, what administration's in power. And this could be a game changer for them and for autos in general. Energy storage, you saw the number out yesterday. I think that was masked by the car delivery number. It was huge. So there are reasons to continue supporting the stock outside of all of these kind of exogenous factors. And I think that at the end of the day is what investors will focus on.
That is the first time, Maddie, that I've heard first buddy. First friend, first pal.
I stole it from a guest from yesterday.
Okay, all right.
That was not an original joke.
Tom, we're going to workshop it. Tom, great to see you. Happy New Year to you. Thanks so much.
Okay.
Appreciate it. Coming up, everyone, Chewy shares, they are jumping, as Destiny's Child would say, after an analyst upgrade. We'll break down today's top analyst calls after the break. We're taking a look at a closer analyst call here this morning to, RBC Capital raising its price target for ServiceNow to $1,210 as part of its 2025 software outlook. The firm optimistic that ServiceNow will be able to monetize generative AI demand with the Pro Plus offerings that it launched in 2023. Shares right now up by about 0.6%.
And Chewy getting an upgrade to outperform from Wolfe Research. The analyst cites 4 major points: improving customer growth, higher net sales per customer, product catalysts, and international expansion. Shares up over 3.5%.
And the artist formerly known as Square, Block, getting an upgrade to outperform from Raymond James from Market Perform. Raymond James also updating its price target to $115. They got some confidence out there, high hopes, if you will, that the mobile payment processor could see double-digit seller volume growth in 2025. Shares right now moving on up by about 3.25%, we'll call it.
There you go. It's perfect. 3.25%, we'll call it. All right. That's going to do it for the morning brief. Stick around for me next hour. More analysis on Catalyst. After that hour, we'll have Wealth with Brad Smith. That's dedicated to all your personal finance needs. Have a great weekend. Thank you. Welcome to Catalyst. I'm Madison Mills. We are 30 minutes into the U.S. trading day. Let's get to the 3 catalysts we are watching this hour. First up, we break down the outlook for the tech trade after the Mag 7 drove most of the market gains in 2024. And we break down the national security risks facing the U.S. steel takeover as President Biden blocks Nippon's bid. We'll also break down what the speaker vote means for the GOP and President Trump's plans for the economy in his second term. Let's take a look at some market headlines to start the hour, sponsored by Tasty Trades. Starting off with the major averages, looking to snap 5 days of losses here. You can take a look at your screen. We're on track to do that. You got the S&P up nearly 0.8%, the Nasdaq up over 1%, the tech-heavy names leading gains for the day. Apple was standing there. You've got, again, that Nasdaq up over 1% on those tech-heavy names. We're going to flip the board over to the bond market, though. Still seeing yields coming off their highs. You've got the 10-year down about 2 basis points, still holding well above that 4.5 level. That key next level to watch, of course, is going to be 5% yield on the 10-year, which could then put more pressure on equities moving forward. But lastly, we've got to take a look at Bitcoin moving back to the upside after a tough entry into 2025. We'll continue to monitor the moves in Bitcoin as we bring you more coverage. And the Magnificent Seven off to a shaky start in 2025 following a sell-off in the final trading days of 2024. Still, the stocks contributed 55% of the S&P 500's $10 trillion market cap increase last year. Joining me now with more, Dave Mazza, Roundhill Investments Chief Executive Officer. Dave, thanks so much for being here. I know you're expecting the Mag 7 to dictate the market direction this year. What is your bull case for continued gains in those names?
Yeah, no, you're absolutely right. The Magnificent Seven have been the market generals now for a few years. And because of their significance in not just the size of their capitalizations, but also their contributions to revenue growth and earnings growth, as they go, so has the market goes. So they have really become the market in and of themselves and dictate really where the trend is. And I think what's interesting, if we think about last year, many people came to the year saying, oh, this is going to be the year for value. This is going to be the year for small caps. Of course, that didn't happen. Magnificent Seven stocks, primarily because of their operating leverage and really firepower compared to the rest of the market, were propelling the broader market higher. When we think about this year, though, the valuations of these names have gotten significantly richer. But the bull case remains their earnings growth. They're expected to continue to outgrow the rest of the S&P 500 significantly. And that's even more superior to smaller cap companies. So really, until we see the idea that smaller companies can continue to grow their earnings and revenue at a pace that the Magnificent Seven can, I don't necessarily see the cause for a long-term rotation.
It's interesting, though, because so much of the market gains have come from that Mag 7, and then there's this constant conversation and concern about breadth, also about valuations. How much do you rate those two concerns in your outlook for 2025?
Yeah, so heading into 2025, or here we are in 2025, I should say, I am a bit more cautious on the total return side than we have seen in the past few years. And the reason being is that a lot of 2025's return was pulled forward into the post-election period, especially for the Magnificent Seven stocks. And that's really driven by vibes, right? We know vibes have been, as hard as it is to admit, a bigger driver of market returns than we've ever seen before. And so a lot of the sentiment did get a bit euphoric, I'd say, in the early part of December. I think the last few weeks have been people taking a bit of those chips off the table heading into this year. So I'm still generally constructive on markets, but perhaps not as bullish as I was even just a few months ago. And that really primarily is just simply because of the price action we've seen.
Well, one of the potential headwinds of that price action is what we're seeing in yields. But I wonder if the opposite move in yields could be just as destructive if we do see yields getting maybe down to, say, 3% or something crazy like that. And that could indicate a hard landing, which would also be bad for stocks. Which move in yields is more concerning to you?
Well, I think you're hitting the nail on the head. Most people actually are not expecting yields to collapse, right? So that would be sort of a bearish idea if that were to come into the markets. What's interesting, though, is we sort of, when it comes to yields, need to be in this sweet spot, right? And so let's call it between 4 and 4.5. When we get above that, markets better get concerned. At 4.75, maybe outright bearish. And of course, 5, I think, could be really actually catastrophic for markets if they weren't beginning to price that in. So we're still in a position where the Federal Reserve needs to kind of really take charge on guiding market expectations of what that looks like, because what we don't want to get into a position is where yields begin to get ahead of themselves, and that actually becomes detrimental to markets, because we know there's been a big disconnect now with what's happening with the 10-year yield and economic surprises. And if we continue to see that diverge, then I do think investors will probably be a bit more cautious here. But of course, time will tell, and we have the opportunity for more data to come in before we get the next Federal Reserve meeting.
Yeah, it has been interesting to see that divergence in economic surprise index versus yields. And it makes me wonder about the macro backdrop. Heading into 2024, we were asking all our guests for their recession calls, and now that's not even really a question. Do you think we've outpriced the risk of a recession potentially too much?
Well, yeah, it's interesting. So, of course, there was a debate about the recession and then what type of landing. Was it going to be hard, soft? No. I think we're really in a position where I think investors probably have, as hard as it might have been for those particularly that were bearish, to admit that we have had a relatively smooth landing here or no landing at all. What is concerning to me, though, is that there's still a lot of exogenous factors out there, right? And so the exogenous factors are what actually impact does any tariffs or trade, particularly retaliatory ones, on the U.S. Come to companies? Are companies going to continue to be able to spend money on buybacks that they have seen in the past few years? And then is there a shock that could come from on the jobs market or still on the inflation front? Because we know the Federal Reserve is now in a position where they need to thread this needle where the market, again, doesn't get too ahead of itself on what the expectations for cuts are going to be, and that corporate profits can kind of continue chugging along that we've seen. And so that's generally why we believe we're in a position where markets remain supportive, but the volatility that we've seen the past few days, I don't want to put too much of a weight on it because people are still coming back from their holiday vacations. But I do think the path forward is going to be a bit choppier than we, of course, experienced in the back half of 2024.
All right, Dave, we got to leave it there. Thanks so much for joining us. Appreciate it.
Thank you.
We're following breaking news this morning. President Biden has officially blocked Nippon Steel's $14.9 billion takeover of U.S. Steel. The White House announcing the decision today, citing national security concerns. Joining me now for more, we've got Jamil Jaffer, George Mason University's founder and executive director of the National Security Institute. Jamil, thank you for coming on to break this news down for us. I want to start on this national security risk. How much of that is an accurate depiction of the reason to block this deal?
Well, you know, Madison, one of the challenges here is that the committee that's in charge of looking at these things, it's an interagency committee made up of federal agencies, including the Treasury Department, the Justice Department, Commerce, and the like. They didn't weigh in on the national security risk. They essentially said, we're going to take a pass on this. We'll punt it over to the political team at the White House to make the judgment call. They're the ones charged with assessing national security risk. They did highlight some concerns here, obviously, of a foreign takeover of the number 3 largest U.S. steel company. But obviously a challenge as well, because these are allies. We're talking about the Japanese. We're not talking about an adversary nation state. And so that trade-off of how do you work with allies on one side, raising obvious concerns and labor concerns that I think are motivating a lot of this there in Pennsylvania. 20,000 jobs in total at U.S. Steel, 2,000 in particular there in Pennsylvania itself.
20,000 jobs is significant, especially at a time when, from a market's perspective, we are monitoring every single potential impact to the labor market. Do you think that that potential macro impact is something that could outweigh any of the national security concerns that this incoming administration might have, which could continue to lead to more of an idea of blocking this deal?
Yeah, look, Madison, I mean, I think the Trump administration has been very clear about this. They share the national security and economic security concerns that arise coming out of this transaction. You know, at the end of the day, we've always thought about this. We've never really said it out loud until fairly recently, but economic security is national security. It's most obvious in the case of China and our challenge that we face with that nation in particular. But this is a key part of national security, and you've got to weigh in those job losses. Look, U.S. Steel with 20,000 jobs is a lot of jobs. Used to be 350,000+ jobs at U.S. Steel. So, you know, obviously that market in the United States has faced a challenge, but we've seen the mistakes of not focusing on strategic markets like semiconductors that have long-term national security impacts. And so this administration and the next administration is focused on those things. Steel is going to be part of that conversation.
Right. It was interesting. We spoke with an analyst earlier who covers U.S. Steel and steel particularly, and he talked about how we have seen that U.S. investment in bringing chips production domestic, and we haven't necessarily seen the same level of motivation when it comes to steel production. What do you make of that approach from the federal government, and do you think this incoming administration could approach that differently?
Yeah, I do think that this administration is going to be very focused on supply chain issues, things like core production, like steel, like semiconductors. We've for many years have allowed a lot of that production to flow overseas, particularly to China. I think we have learned the lesson of that. We saw it early in the pandemic with pharmaceutical precursors, with protective gear and the like. And there's much more to be done on that front. We're not going to bring all that manufacturing back to the United States. It's just not realistic. But can we ally shore it? Can we bring it to places that are other than China? And so the question then is, okay, if you're going to ally shore, right, what's the challenge with an ally, Japan or a Japanese company, buying a U.S. steel company? And that's, I think, where this question plays out. If we're going to say we're going to work with allies on one front, how does it play out on the steel front? We got to keep some of that production here, but we also got to be able to work with our allies. That's the hard part of the trade, Madison, here. And I'm not sure we've quite figured it out. This administration, the new incoming administration, will absolutely be focused on how to find that trade right. Remember, President Trump, very pumped about the SoftBank investment here in the United States in artificial intelligence. That's a Japanese investment fund as well.
So then how do U.S. investors kind of rate potential upcoming M&A, given that there's not necessarily one central thesis from either administration, from the current or incoming?
That is probably the $20,000 or $100,000 question, I think, for investors, right? Because the challenge is, we know that the U.S. wants to engage in strategic M&A. We want to work with our allies. We want to sell companies to allies, buy allied companies, do joint ventures. At the same time, we're saying if it's too strategic an industry or an industry that has significant impact on jobs, particularly in battleground political states, right, that might be a challenge for you. And so I think as investors look at this, they're going to have to weigh not just the traditional national security consequences of the traditional adversary nations, but also, even when we're talking about allied nations, how much of a labor impact does that have? What kind of a political impact does that have? And the Trump administration, as the Biden administration has, is going to be looking at those issues, knowing even though they don't have a re-election fight ahead, they've got a congressional election coming up in 2 years, and they're going to want their nominee, potentially the vice president, to run for office again. That's going to be a key part, as politics and economics will play a role in national security, as it always has.
I want to switch gears a little bit, Jamil, and talk to you about some events over the weekend, the terror attack in New Orleans and the explosion of the Tesla Cybertruck outside of the Trump Hotel. I'm curious from your perspective, we've heard from officials that there's not a link between the two, but it has raised national security concerns, especially amongst citizens, and now some reports that the individuals involved in both could have potentially known each other. What should our viewers know about any national security risks that those two events in tandem might raise?
Well, look, certainly we know that the attack in New Orleans conducted by Shamsuddin Jabbar was ISIS-inspired. We don't know if he was directed by ISIS or not, but we know that he was inspired by that group. He had an ISIS flag on his truck, had a number of social media posts that suggested this attack was being undertaken in part because of that. He obviously had mental health issues and financial and personal problems as well that certainly contributed to his decision. The thing I think the American people need to know about that is the international terrorism is not gone. Al-Qaeda and ISIS still believe they are very much in a war with us. They want to attack Americans here in the homeland. They want to recruit Americans to conduct attacks here, as well as our allies in Europe to conduct attacks there as well. We can't take our eye off that ball. The prior administration withdrew from Afghanistan. The Trump administration has been focused here at home. We're going to need to fight this fight. Better to fight it overseas than here at home. And the question of a connection between Las Vegas and New Orleans is hard to know at this point. As you point out, Madison, the authorities have said we don't know about any connection. At the same time, the coincidences are strange. Both trucks were rented on the Turo car-sharing app. They both drove across multiple state lines to get to where they needed to be. They both had military backgrounds. They both served at Fort Bragg and in Afghanistan around the same time. We don't believe there's a connection, but again, with the fog of war early in the investigation, that may change over time. As of now, no connection that we know of.
All right, Jamil, thanks so much for joining us on that breaking news and for the breakdown there. We appreciate it.
Thanks, Madison.
Coming up, we're looking at Yahoo Finance's trending tickers. We'll give you the news behind all those stock moves next, right here on Catalysts. It's now time for some of today's trending tickers. Scan that QR code on your screen to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now on set, we've got Yahoo Finance's Josh Schaefer. And first, Josh, we're going to talk about Berkshire Hathaway outperforming the S&P and notching its best year since 2021. Huge year for the stock, up 25%. And it's been interesting because we've seen Berkshire selling some stocks like Bank of America, but then adding the likes of SiriusXM. I love the call her daddy to Warren Buffett pipeline there. It's very interesting. Not on my bingo card for 2024. What are you watching when it comes to the Berkshire story?
I mean, I'd love to sit in on that conversation with Alex Cooper and Warren Buffett, right? I think that'd be pretty fascinating. But overall with Berkshire, another year of outperformance over the S&P 500. Also, you zoom out over the last 5 years. I was looking at Berkshire B shares, perhaps a little bit more affordable for most of us, right? Not in the $100,000 range, $600,000 range. Berkshire B up 98% over the last 5 years compared to the S&P 500, up 81%. The thing that I think is important to point out too, when we talk about Berkshire stock performance, we love to talk about what Warren Buffett is buying in public equities, right? But remember, a large part of their revenue is coming from the private companies that they own, right? Think about their insurance business with Geico. That's part of what's driving the stock higher too. It's not just owning shares of Apple, owning shares of Bank of America, American Express. I do note though, American Express up over 60% over the last year, so one of his best holdings and one of his largest holdings. But I think entering 2025, Maddie, the biggest question with Berkshire is Warren Buffett is sitting on a boatload of cash right now, and people want to know what he's buying. Back in November, people were sort of speculating, is this a market warning sign? If Warren Buffett's sitting on so much cash, does that mean that he thinks stocks are going to come lower and he wants a good buying opportunity? I don't really know how much credence there actually was to that, other than it seemed like he was doing perhaps just normal rebalancing of a portfolio. Apple grew a lot for Berkshire and was up about 40% of their portfolio. So it sort of made sense to sell some of that, but they've been selling Apple, selling Bank of America. The looming question is, the next time we get a filing from Berkshire, what will be added with some of that cash, or will nothing be added? And we'll keep sort of wondering this question of where he's going to get in, maybe leading all the way into the annual meeting in May.
Right, and we know that he loves to look at the kind of confluence of GDP growth versus the expensiveness of stocks. And so some of that has been at record highs too, which could be a reason for some of that selling off, but always an interesting indicator to get Buffett's thoughts on the market. Josh, thanks so much for joining me. Appreciate it. Other trendy tickers we are watching today, alcohol stocks under a bit of pressure after the U.S. Surgeon General issued an advisory calling for cancer warning labels on alcoholic beverages. Yahoo Finance's Anjali Kemlani joins me now on set with more. Anj, start by just telling me what we know from today. What happened?
So what we know is that the U.S. Surgeon General is basically trying to create more awareness about the relationship between cancer and alcohol, citing the numbers of deaths that are preventable in the U.S. from alcohol consumption. There's already federal recommended intake of alcohol, 1 drink or less per day for women and 2 or less for men. In addition to that, there's already been labels on alcohol about use before driving heavy machinery, as well as consumption during pregnancy. So all of that now will have an additional, if Congress passes this rule, to add to the label about the harmful, about the harms of cancer and the potential tie there. We've seen the numbers over the years. You know, there's been the Sober Curious movement. You've seen mocktails pop up on bar menus. This is just sort of culminating all of that public push. Also interesting to point out that Trump's FDA pick, Dr. Marty Makary, has already been an advocate of this. So it's interesting timing there. And then we do know that in the Surgeon General's report today, there was an interesting statistic about the fact that only 45% of Americans are aware that there is an alcohol-related cancer risk.
Cancer risk.
So,
that just seemed so important to me, and I'm sure is part of his call on issuing this now. And a great point too that you have of the incoming administration mirroring today's news here. I just want to ask from a consumer perspective, how worried should people be? I feel like study after study that I've read, not as a health reporter, I can get different answers from each about the cancer risks of alcohol.
Yeah, there have been a number of studies that have suggested that there is a relationship. There also have been some who have said there still needs to be more studies done to kind of cement this idea and find the actual relationship. There are certain cancers in particular that are cited, breast cancer for women, as well as more stomach and liver cancers for the general population. I think what we know, and to your point, the American public is not unaware of this. We've been having this conversation for years. Since 2019, when the Sober Curious movement started, there was a survey around that, actually a survey last year that pointed to 41% of Americans trying to drink less alcohol. So it's not like we're less aware. It's just the idea of maybe creating more awareness and having more conversations the same way we do about tobacco use. That hasn't necessarily stopped. Vaping hasn't stopped. So I think the idea being, let's let the government at least have the label on it and have everyone make the decision for themselves the way that we do for everything else.
Right, exactly. Well, Anj, thanks so much for bringing your reporting on this and giving us that context. Appreciate it. Utility companies Vistra Energy and Constellation Energy saw massive gains in 2024, with Vistra being the top performer in the S&P 500, up over 250%. Those companies seen as benefiting from big tech's push into clean power to fuel the surge in AI demand. Our next guest sees other companies that could also be well positioned to benefit from investment in power generation, wires, or both. Here on set, we've got Carly Davenport. She's the Vice President in Global Investment Research covering U.S. utilities at Goldman Sachs. Carly, thanks for coming in studio. We appreciate it. Talk to me about what we're seeing here. At this point, we've talked a lot on the show about Constellation and about Vistra, but you bring up some other really interesting names in the space that we haven't talked about here. What are some of the driving factors behind those second derivative AI plays that you're looking at?
Yeah, absolutely. As we think about this power demand inflection theme, right, there's, a lot of different companies that could be potential beneficiaries. The one that comes up less often than some of the others that you mentioned are the regulated utilities. And that's where we've been focusing, because as we think about this theme, there's so much investment that's going to be needed to prepare a system that hasn't seen power demand growth in over a decade to be able to actually connect all these facilities to the grid. And so we think the regulated utilities are very well positioned to do that. And we think it's going to drive an expansion in their capital investment. We see our coverage spending over 40% more over the next 4 years versus the prior 4-year period, which will contribute to an expansion in their earnings power to about 8% growth over the next couple of years versus a historical average where these companies have only grown about 4% per year. So a big step change in demand, which will contribute to that earnings growth, which is why we're excited about the companies that can invest to help facilitate that change.
Yeah, and I know one of those companies in particular is NextEra, and you are going to have a keynote on that, your utilities conference coming up. Talk to me about NextEra Energy. It's also a company that just had a huge dividend spike. What should investors know about the bull case there?
Yeah, we're really excited about our keynote with NextEra down at our conference next week in Miami. It's really well timed, we think, because the stock has lagged a lot post the election. It's underperformed the market by about 10%. But we don't think a lot has changed with the growth outlook of NextEra. This is one of the largest developers of renewable power projects in the world. Think your wind, solar, battery storage projects. And when we think about facilitating this data center, this AI power demand growth, a lot of the companies building these facilities, they want renewables to be a part of the mix. They care about their carbon emissions footprint. And NextEra is very well positioned to build those types of projects out. So when we think about the growth of renewable power, we think they'll build about 45 gigawatts of new projects through 2027, which on our numbers will drive about 10% average earnings growth for this company through 2027, which again, compared to that 8% for our coverage, we think looks attractive. And because the stock has underperformed, we really see valuation as attractive here. The stock's only trading at about an 8% PE premium to our coverage group. And over the last 10 years, that premium has been about 30%. So we think it's a really attractive entry point for investors here.
It's an interesting moment in terms of just the innovation in the space, as I'm sure you know very well. And I spoke with Tom Steyer at our Yahoo Finance Invest conference, and he was much more bullish on things like wind and solar power versus something like nuclear that he felt was a little bit too far down the line. He wanted to invest in things that can make a real world impact today. I contrast that with what we've heard from the incoming administration, from hyperscalers, very bullish on nuclear power. What is your take?
Yeah, we really think this is going to be an all of the above approach, right? We We are coming off of an era of no power demand growth, and now we've got, on our numbers, 2.5% power demand growth per year in the US through 2030. We're going to need everything we can get. It's going to take renewables, wind, solar, battery storage. It's going to take new natural gas-fired power generation. And we do see path for incremental nuclear capacity as well. We've seen announcements of restarting previously mothballed nuclear plants. We saw it with Constellation, with 3 Mile Island. There's talks of NextEra has a mothballed nuclear facility called Duane Arnold that they could restart. So there's opportunities to bring that nuclear capacity online. There's uprates, which would just be expanding the capacity of existing nuclear plants. Again, companies like Constellation have talked about that publicly. So we do see opportunities, but when we think about new large-scale nuclear facilities or these small modular reactor technologies, I think we would agree those are a little bit longer dated. We'd think kind of mid-2030s for those types of investments to really be able to make a commercial and scalable impact.
And how are you thinking about any regulatory or policy impact from the incoming administration and how that could impact the space?
Yeah, the biggest focus really has been related to NextEra in particular, the future of the IRA and energy transition policy. We do think we're in a bit of a different position today because the tax incentives supporting renewables are not necessarily the only things driving the uptake of these projects. We now have demand from these big companies like the hyperscalers that are really helping to support this renewables growth. So we still feel good about our projections for that 45 gigawatts of renewable power projects for NextEra over the next few years. And we're not as concerned about that broader risk that the IRA tax credits are fully repealed.
And given that, and we've touched on this a bit in the conversation, but for investors listening, is the path to getting in one that looks like owning a basket of these names, or is it more of a stock picker's game right now?
Yeah, we think among the regulated utilities, it is more of a stock picker's game. There's certain markets regionally in the U.S. where you'll see more of this growth materializing versus others. And there's certain companies that, have ability to build power generation and transmission and distribution on the wire side. They can get the full gamut of that value chain. Others can only invest in the wires. And so it really, we think, is dependent upon which markets are you seeing this growth actually materialize in a big way, and which of the utilities are serving those markets that can benefit from that need for increased investment.
All right, Carly, thank you so much for joining us.
Thanks for having me.
Really appreciate it. Thank you. And as we head to break, taking a look at shares of Ford as the company reports its quarterly deliveries here. I'm just going to pull up what we are seeing in terms of those deliveries here, but you've got the stock up just about 0.3% off the back of that. It's really interesting noticing here what we've seen with Ford, especially given some of the news that we had with them filing for a recall of vehicles at the end of 2024. Now we're seeing that their fourth quarter sales were up 9%, fourth quarter U.S. retail sales up 17%. Their EV sales, this is the big number that's important to note, up 38%. And this obviously comes a day after Tesla missed on their expected vehicle delivery estimates here. We've spoken with analysts who said that those estimates were just a bit too high. Having said that, though, Tesla stock down about 5% after that news crossed yesterday. Rivian also this morning beating on their estimates as well. Again, reminder here, Ford's 2024 EV sales up 38%. We'll have much more ahead right here on Catalyst. Stick around for more. Some breaking economic data this hour. ISM manufacturing for December showing an advance for second month as orders and production picked up, suggesting the cloud over manufacturing could be starting to lift. The gauge rose almost at a point to 49.3. The gauge rose almost a point to 49.3. That is the highest level since March, according to data released today. While still below 50 and indicating activity continues to shrink, the index was firmer than all but one estimate in a Bloomberg survey of economists. The group's measure of new orders rose more than 2 points to 52.5, the strongest reading since the start of last year and matching the highest since May of 2022. I also just want to mention prices paid ticked up a bit. Employment reading, though, falling. This is going to be really critical to watch, falling to 45.3 from 48.1. That is going to be a key focus for the Federal Reserve if we do see weakness in the labor market. And of course, we'll focus on that in next week's payrolls print. The 119th Congress takes office today and is set to vote at noon on the new Speaker of the House. Current Speaker Mike Johnson has been endorsed by President-elect Donald Trump, but faces a tight race where he needs to secure nearly all Republican votes to win. Multiple Republicans have already pledged they will not vote for Johnson, and Democratic Majority Leader Hakeem Jeffries has said Democrats will all not be voting in Johnson's favor. A speaker must be elected before Congress can certify the presidential election results on January 6th. Speaking to reporters this morning, Johnson said Republicans need to unify.
My simple message to my colleagues is make suggestions about process improvements. We're open to that at all times, but I don't make deals with anyone. There's no quid pro quo here. I don't do anything in exchange for a vote.
On Truth Social this morning, Trump wished Johnson good luck, writing, quote, "A win from Mike today will be a big win for the Republican Party." And with a new government set to take shape, investors are looking for how to approach Trump 2.0. For more on this, I want to bring in Jay Pulaski, TPW Advisory's founder. Jay, I always love speaking with you because you have such a global view, but you also obviously look at what we're seeing domestically here. And you had that big capitulation on election night after the win of Trump, which you had not necessarily anticipated. How have you changed your outlook for 2025 in the months since we got that election result?
Yeah, thanks, Madison. Great to see you, and thanks for that reminder. That was a tough night. But look, as we see it, there's a lot going on. And right now, today even, you have an oversold condition in bonds. You have stocks that have flipped in a matter of weeks from being overbought with excessive enthusiasm to being oversold. Probably the worst 5 or 6 day run for the S&P in 50 or 60 years. You have a dollar that's overbought and seems to be wanting to break out. And then at the same time, you have commodities catching a bid, which is quite unusual. Dollar strength and commodity strength do not typically go together. And that last one for us is really, really important because our view is that we're in the early to mid stages of a long cycle, which we calculate from 2023 to 2027 or beyond. And that is really being driven by a complementary global growth cycle and a global equity bull market. And they reinforce each other by the earnings channel. And so if commodities are able to sustain a breakout, then that would reinforce this idea of a global growth recovery driven really by stimulus in Europe, led by Germany, which is facing stagnation. And then in Asia, led by China, which is facing deflation. And so we really see President-elect Trump as a positive policy catalyst abroad, going to reinforce the need for stimulus in Europe and in China, and kind of a chaos agent at home, as we've already seen with the attempts or the near closing of the government just a week or two ago. And we think that is being reflected in interest rates, which are up, almost 100 basis points. A lot of that due to concerns about the deficit and the economic policy mix under the president-elect.
It's such a fascinating view on the end of some of that global weakness that we have been seeing, Jay. Do you think that also comes alongside a waning of the U.S. exceptionalism that's seen the likes of record-breaking U.S. equity ETF inflows in 2024?
Yeah, you nailed it, Madison. I mean, that's exactly it, right? I mean, U.S. assets are priced for perfection. They trade at record valuation premiums versus the rest of the world, whether you're talking about stocks or the dollar. And we're completely, well, not completely, but very dependent on foreign inflows into the Treasury market. We have huge Treasury maturities that need to be rolled over in 2025. And so foreigners are more heavily invested than they've ever been in U.S. financial assets. U.S. investors are heavily invested, particularly in equities, and no one owns commodities. No one owns emerging markets. No one owns non-U.S. And so, yes, we are positioning for a shift in what has been a long-running trend since really the bottom in 2009, the great financial crisis. U.S. assets have outperformed, led by technology. Our view is that the U.S. story is going to start to deteriorate while the rest of the world is going to start improving their policy mix, again, led by Germany, which really has to act. We think they're going to act after they have a new election in the spring, and China, which is facing, a national security issue, arguably, where they have an export-dependent economy with President-elect Trump threatening 60% tariffs. They know that they have to stimulate domestic demand, and they are doing so in part to fight deflation. So there's a domestic policy process that encourages stimulus outside the U.S., and there's the fear of President-elect Trump reinforcing that. And that's why we say we view Trump as a positive policy catalyst abroad, and that's not a normal or consensus view. But we think that suggests that there's really an opportunity. And here's the point we want to really make. Year 3 in a bull market, and that's what we're in the U.S., year 3, tends to be a kind of rest year, single-digit type returns. And so that's a perfect environment for non-U.S. to do well, because you and I both know when the U.S. is up 25% like last year, nobody cares about non-U.S. When the U.S. goes down 15%, everything goes down more. So a kind of quiet rest year where the U.S. can kind of catch up to the multiple expansion it's enjoyed in the last couple of years is perfect for the non-U.S. markets to kind of make a move. And so we're watching emerging markets very carefully, led by China, which, again, few people recognize and understand, but China large cap stocks actually outperformed the S&P in dollars in 2024.
It's a great point and a really important view to remind our viewers of, Jay, especially given the weakness we saw in China stocks to kick off the year, and also dollar China breaking through that 7.3 level for the first time since late 2023 this morning. We'll have to bring you back to talk all things China stocks next time, Jay. Thanks so much.
Thanks, Madison. Great to see you.
You too. We're going to have all your markets action ahead. Stay tuned. But before we get to break, I just wanted to take a look at shares of NVIDIA. Having a huge pop off this morning. They were up over 4%. Now you can see those gains just about above 3.5%. It's going to be interesting because if they do rise as much as 4.3% today, that's going to break out of a key technical level, that June resistance points for NVIDIA shares. That could obviously lead to another kind of ground underneath this stock, which has been under pressure as we head into the end of 2024. If we do start to see it breaking above that June resistance level, that could present a new opportunity for more growth for the stock. And obviously, as goes NVIDIA, so goes the rest of the market. So this is, of course, driving some of those broader gains that we're getting in the Nasdaq this morning. Much more still to come. Keep it here on Catalysts. exactly 1 week, on January 10th, the Supreme Court will hear arguments on whether the law forcing TikTok's sale or ban is constitutional. Here with what we can expect from the Supreme Court is our very own Alexis Keenan. Alexis, lots to talk about when it comes to the potential TikTok ban. What do we need to know heading into next week?
Yeah, so what the Supreme Court is going to address is the question of whether the First Amendment's speech protections make this law unconstitutional as applied to TikTok, the Chinese company, as well as TikTok users. There's two parties in this case. The cases are being heard together, and they have similar arguments, but there are differences there as well. So the court is going to hear arguments on Friday, so 1 week from today, and they're going to hear from the Justice Department, as well as TikTok and those users. And it's going to be arguments for and against the government's claim that national security justifies this law. Now, if you remember, TikTok had asked the court to pause enforcement of the law, which is set to go into effect the day before Trump is sworn into office for a second term. On January 19th is the date that the law is effective, so 1 day before there. But instead of doing that injunction for TikTok, the Supreme Court instead tabled that request and decided to hold this hearing. Now, the options for the court at this point then are to either hold this law constitutional as to these two parties or unconstitutional. But if they do find that it is constitutional, they really don't have, the Supreme Court does not have really then the power to pause the law from going into effect.
So then that leads perfectly to our next question for you. What power does incoming President Trump have then?
Yeah, so it's interesting. He filed a brief in the Supreme Court, which is really unusual for a president who's not been sworn in yet, right? He doesn't really have the standing necessarily. He's not really a party situated where the court would definitely consider and let him weigh in as a party, like we would call it standing, the situated in, to be able to bring that into the court. So while he did that, they may or may not consider it. They don't have to. Trump, of course, promised, though, that he would try to save TikTok. So this is all, I guess, part of that. He wants to negotiate a solution. He wants time to do that. But also he could direct the U.S. Attorney General to not enforce the law. But you have to consider that the law makes it illegal for companies like Apple and Google to carry it and distribute the app. So they don't want to necessarily be breaking the law. So can't really bank on that.
It's expensive for them, right? Depending on the downloads. So that's, yeah.
Sure, absolutely. And I think at the base, though, they're not going to want to be breaking the law because they don't want to be accountable for it later. Also, the president, once he is sworn into office, could try to persuade Congress to amend it and make it look different than it looks today, because Congress is not very likely to just overturn a law that they just passed with overwhelming bipartisan support. Also, you could claim that Trump could. There's this nuance in the law where the president is the one tasked with certifying whether the company has been divested. Mm-hmm. So whether it has or has not been, there are legal experts who say, well, Trump might try to say it's been divested when it really hasn't. Again, probably a bit of a stretch, but certainly so many different companies at play here that could be impacted. You have the social media platforms, you have Meta, you have X, you have Truth Social even, Trump's Truth Social, all in the mix here fighting for advertising dollars that possibly are now flowing to TikTok that if this ban goes into effect might not be going in that direction.
All right, Alexis, thanks so much for breaking that down for us. Really appreciate it. Coming up, we're going to break down the outlook for venture capital in 2025. Before we head to break, watching shares of U.S. Steel here down a little over 5.5%. We're getting in some headlines. Nippon Steel and U.S. Steel responding to President Biden's decision to block the deal officially here. Nippon Steel and U.S. Steel saying they will take all appropriate action and that Biden's decision violates due process, condemning the U.S. government's decision here. Also saying the decision violates law governing CFIUS outlet, so that's going to be a really important thing to watch. I'm still reading through this entire statement here, but the line that sticks out to me: we are committed to taking all appropriate action to protect our legal rights to allow us to deliver upon the agreed upon deal of $55 per share for U.S. Steel stockholders upon closing. We're going to have much more ahead right here on Catalyst, so stick around for more. artificial intelligence has overwhelmingly attracted Wall Street interest and venture capital dollars in recent months. Our next guest has a moderately positive outlook for VC in the new year, but cautions that doesn't mean challenges are gone. Here with his 2025 outlook, we've got Kyle Stanford, PitchBook's senior venture analyst. Kyle, great to have you on. Thanks for making the time. I want to start with your outlook for VC fundraising. You do see an increase from 2024, but it presents some cautious optimism, the outlook potentially going to be constrained. Does that mean that 2025 won't necessarily be this big exit year that some folks are anticipating?
Well, I think there's two ways to look at that, right? I think if you start to see IPOs not happen until the second half of the year, there's not going to be a huge wave of distributions that actually come to LPs in 2025. M&A is really where those distributions can come back very, very quickly, right? And so what we see at the changes at the FTC and how that interacts with the M&A market, I think will have a big impact on the actual distribution levels of 2025. We know it's been incredibly slow, but there are a huge number of companies that need to exit. There's a unicorn population is very aging. Most of them haven't raised in about 2 years. And so we should see some movement towards the beginning half from the M&A market and some more companies start to file. And that will really give us a good look at what we should expect in 2025.
You sent over a great list of unicorns that are likely to IPO this year. Of that list, which of them do you think fall into that category of they kind of need to go ahead and IPO this year? The clock is ticking on their IPO dates.
I mean, you can probably go down that list and pick any one of those and say it probably needs to start to look to the exit market. You know, someone like Databricks or OpenAI, these companies are the ones that don't need to go. They have ample opportunity to raise capital for secondary transactions and get liquidity to investors and employees that need some. But when you look at some of those companies that you have up there now, Chime and Discord, right? Those companies are aging. Again, you know, 40% of unicorns have been held in portfolios for 9 years or longer. And so that entire list that we put out there is really looking at those unicorns that we believe are need to IPO or will be going through the IPO markets and are aging and kind of need to get the ball rolling on that exit.
What's the biggest potential blockage of some of these IPOs for 2025?
Sure, right. I think the first thing we'll be looking at is how the market reacts to the new administration's policies, right? We've seen some positive signs. You know, the last 2 years have been very positive from a performance standpoint in the public markets. But we haven't seen the IPOs going forth that we probably would have expected with that positive movement. If the market starts to see a lot of volatility with the proposed tariffs or any of the other policies that are implemented kind of day one or the first few days of the administration, that could throw a wrench in the plans for some of these unicorns, at least from the early part of the year. Again, I think the end of the year will be where most of these unicorns are looking to start to go public, especially once they can show full year 2024 financials and really see how the market's going to react to the policies. But the first few days of the Trump administration, I think, will give us a good indication of what the market will do or how they will react to those policies.
And obviously, a lot of the companies on your list are in the IT space, but I do want to talk about some news from today, the blocking of the U.S. Nippon Steel deal. Does that throw any cold water on some potential M&A activity or excitement about regulatory looseness on M&A heading into next year?
I would say that probably falls right into what the Trump administration would or has kind of proposed, right? It's a foreign buyer looking at a U.S. product that is, kind of against what the much of the election race was run on. So I don't think that throws too much cold water on the proposed or the hopefulness of the M&A market from a U.S. company to U.S. company. I do think, large mega cap tech stocks, Amazons, Apples of the world are not going to see the loose regulations that many would probably hope. They have obviously been a target from the past few administrations. But I don't think the steel blockage today is going to be an indicator that M&A is not going to come back like we all are hoping.
All right, Kyle, great stuff. Thank you so much for joining us. We appreciate it.
Of course. Thank you so much.
Coming up, we've got Wealth dedicated to all of your personal finance needs. Brad Smith coming back. He'll be with you for the next hour. Stick around for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, can investors still bet on mega cap tech stocks outperforming in 2025? I speak to a strategist who still sees room to run in the space in just a few moments. And we're heading into the first weekend of 2025. Before you hit up those open houses, check out the tips that we'll be getting later on in the hour from a real estate advisor. Plus, high prices for certain foods may not be a thing of the past. An economist lays out the 3 breakfast foods that you may want to keep your eye on this year. All that and much more coming up during today's show. But first, we take a look at some of the market action. We're 90 minutes into the trading day here on this Friday. Stocks rising today, looking to snap the longest losing streak since, let me check, April 2024. Joining me now, we've got Keith Gangle, Gradient Investments Portfolio Manager here. And Keith, you're bullish on large cap tech. You see it continuing to accelerate this year. Why is that?
We like it. I mean, the fundamentals are still solid. The growth rates are there. Valuations are very reasonable. If you go back in December, the Mag 7s were up almost 4%. The market S&P was down about 2.5%. So you're starting to see that shift back towards some of these mega cap names. And I think you have to be selective within the group, but we like the fundamentals. Again, the growth rates are, 15, 20%, where the overall market's growing 10%. Valuation slightly above market multiples. So we think it's a space you still want to own. But again, you have to be selective within them.
Okay, and so if you are being selective, which ones then are the top picks?
Amazon's our favorite by far. Valuation is very reasonable at about 34 times PE multiple, which sounds a little bit high relative to the market, but the growth rate's a lot better. We like the fact that it's a half consumer business with obviously the retail side of things, but we also like the AWS business, which is their big tech. That's a play on AI as well. They're improving their margins. They had a big CapEx spend a couple years ago. That's actually starting to flow through right now, and the margins are increasing. So that would be our favorite of the group. Our least on the other end of the spectrum would be Tesla. It's a name we don't own. Valuation is very extreme. It's had a nice run since the election, but we think that's actually due for a slight pullback. Again, we want to be selective within the group. Amazon would be our top pick. Tesla's a name we don't own. Apple's a name, again, one of the Mag 7s that we actually own, but it's one of our least favorite as well. We think valuation stretch on this name for the growth rate that you're getting.
I have a note in my inbox here that I was looking at before the show from UBS, and their chief investment officer for the Americas saying that the AI rally is far from over. Within the names that you were mentioning, and one of the core kind of features in the thesis of that Mag 7 trade has really been around artificial intelligence as well. How do you believe that continues to transpire here in 2025?
Sure. I think we're still in the very early innings. I think we're starting to shift from the semiconductors. NVIDIA, which is obviously a leader in the AI space, is going to go more into the software space. And that's going to be names like AWS with their platform with Amazon. You got Meta, you got Google. Those are all plays in the software side of things. And again, even Microsoft with Copilot. And there's other things like that. So we think it's going to shift from NVIDIA's massive outperformance the last 2 years to names like Amazon outperforming, Google, Meta. Those are names we like to be more on the software side of things. But we do think AI is in the very early innings of it.
I was looking at your notes that you sent over, and it was particularly interesting, especially as a lot of investors are trying to grapple with the fact that we've had this period, this 7-day period, 5 trading days, 5 final trading days in 2024 and the first 2 here in 2025, where it looks like we're looking at a reality sans Santa Claus rally. What does that tee up for the rest of this year?
Well, it shouldn't be a big surprise. If you go back 2 years, in 2023, markets are up 25%. Even with the pullback end of last year, the markets almost finished up 25%. So again, back-to-back years at 25%. So it should be no surprise that we actually see a little bit of a period of a correction. It's a minor correction. We're, down 3-4% off the highs. If we look out through the full year, we think fundamentals are in place for a strong year performance. Earnings are expected to grow 15%. And this group I just talked about, earnings are expected to grow faster than that. So if earnings grow 15% for the overall market, we think the market can grind higher. It won't be a straight line. We'll see a little pullbacks like we've seen, but it's not unusual to see that at all.
What do you think the reason is that Santa didn't deliver this time around?
I just think we pulled a little bit forward. We've seen a lot of gains earlier in the year. Again, we were almost up 29, 30%. So we finished the year up 25%. Is 25% that bad? No, it's a fantastic year. The markets don't move in a straight line. We, as investment professionals and investors, we love it. If the markets were consistently up, 1% every month, that would be great. It's not realistic. And I think it's just a little bit of a pullback. Market's got a little bit extended. Valuation's getting a little bit full. And now we'll wait again. We got a new administration coming in. We got earnings coming around the corner. So those are some of the key metrics investors will be watching over the next couple of weeks to determine the direction of the overall market.
I've been getting a bit of a roundup of comments on this. Is it realistic to expect what FactSet has looked for and a lot of other strategists are seeming to be in alignment with, which is S&P 500 earnings growth for the year, calendar year 2025, of 15%?
Yeah, we think that's too high. I mean, last year was at 10, 11. I think we're finishing around 9%. We're starting this year at about 15%. We think that's too high. But again, historical average for the for earnings for the S&P 500 have been about 8%. So even if we do that 8 to 10 to 12, we think we're more like that 10 to 12. We think that'd be a fantastic backdrop for the overall stock market. 15, I think, is too high. I think as we go throughout the year, that gets dialed back.
What do you think the deep value play is for 2025 here, Keith?
That's a good question. Deep value, I think, names like of the Meg 7, I think would actually have to be Alphabet. That name's at a market multiple, growing faster than the overall market. That's a name that's got a lot of different issues going on. Whether AI is real or not for them. Are they behind? When Microsoft launched, they seem to be behind. We think they're catching up, and they have all that search query data from all their history. I think that's kind of the value play of the group.
Really interesting, Keith. Great to have you on here with us. Happy New Year to you. Appreciate the time.
You as well.
With the new president, lower interest rates, and potential tax changes coming up, it's the perfect time to start financial planning for 2025. And here to help, we've got Rob Williams, Schwab Center for Financial Research, Managing Director of Financial Planning here. Great to have you here with us. Let's just dive right in because it's already the second that we got into the new year. A lot of the friends that I was around looked at me and said, all right, well, I guess it's time to start working on our taxes, huh? So if people are trying to start getting ahead of the curve of filers that are out there and also getting ready to submit all of their paperwork into the IRS, how can they set themselves up for early success?
Well, you're right. It's the beginning of the year, and tax is kind of a year-round activity, but it really picks up now. And clearly, just for the year in general, we're looking at the new policy, the new sort of administration, and what may sort of be coming for taxes, over the next year as we look at the Tax Cut and Jobs Act. But as you're getting into tax season and preparing for it, it's really getting all your paperwork and things together. Taxes ends for the most part at the end of the year, so now it's really the filing and reporting. There's a few actions you can still take, like contributing to IRAs and Roth IRAs and a few other actions, but for the most part, 12/31 is that drop dead date in terms of most of the actions you can take to 2024. Now we're starting to look into 2025 and beyond.
Certainly. So, Rob, all these things kind of considered and what's been the status quo for filers for the past 4 years, essentially here, or plus, I should say. Now, as we get towards the Tax Cuts and Jobs Act renewal and how that's going to be talked about in Washington, D.C., what are some of the changes that could or should be anticipated by tax filers?
Well, with the election, which obviously we're all watching to see how that worked out in the Republican majority, it probably clears up things a little bit. For those of you who haven't been following it, the Tax Cut and Jobs Act, which was passed in 2017, was really a major tax cut across the board, and mostly for individual taxpayers. That expires officially at the end of 2025. But now with the new administration, I think all bets are on likely extending major parts of it. That can include lower income tax rates, keeping them where they are. Includes removal potentially of the SALT deduction. And so overall, this makes the picture a little bit clearer. Now, that doesn't mean that all of the campaign promises and everything will go through. There's been a lot of proposals, but this still has to go through Congress, and we know that proposals don't always work out in terms of the fine print. We do think it'll probably happen a little bit faster if a lot of these tax laws, they pass kind of December, right at the end of the year. But with the majority, it's possible Congress can move a little bit more quickly using budget reconciliation and some other actions. So it doesn't suggest any major changes for investors that we work with, but just we continue to watch for tax opportunities when it comes to sort of year-round tax planning. as we move into those tax changes in 2025. I just add, none of them would take place until 2026.
Right.
There are tax law changes, so that's helpful to keep in mind as well.
Yeah, certainly. And I like that we began the conversation here because this is one of the major themes, one of the three themes actually, that you're looking out for here. It is part of your 2025 financial planning outlook here. What are the other two major themes?
Yeah, overall, it's shifting gears, but you could say that almost every year. But it's a gradual shift. New administration, interest rates, inflation. So tax was the first. That's a theme we're watching. But the other is higher prices and inflation, but also in the financial planning space, as well as wealth management, rising risk management costs. So those are two themes we're talking about and providing some thoughts to investors on how to manage them.
To what extent do you expect that we'll continue to see disinflation or at least moderating inflation to the point where there can be some comfortable financial planning that takes place going into and at the start of the year versus having to, and everybody's going to continually adjust to their financial planning perhaps, but the hope is that you don't have to do so drastically because of an inflation spike due to tariffs or due to immigration policy or what have you that may come?
Our view is that tariffs at this point aren't likely to be a major catalyst for rising prices. We'll see. But more generally, I think in the planning space, inflation is both a mathematical issue and it's also an emotional issue. We feel it. We hear investors, it's one of the top concerns we hear. 77% of people we ask tell us it's one of their major concerns. Over a quarter tell us it might change their retirement. So the question is what you do about it. I think one major point is disinflation. You use that term. We're not seeing that. Disinflation would be a negative. That would be prices falling. So I think that's really something we talk about in planning and then really in investing too. Prices are permanently higher. Certainly some things may drop, but the pace of inflation in November was almost 3% year over year. So that's still a pace that the Fed is looking for. We're not seeing prices fall. So how do you plan for it? There's a number of steps. One is to stay invested. Diversified portfolio of stocks is really the best way to outpace inflation over time if you have the right time horizon. We're also talking, as often you do with inflation treasury, inflation protected securities. They look fairly attractively priced now. But the last is just a planning point. Don't overreact. It's an emotional issue, but it shouldn't really hopefully change wholesale your planning or your investment strategy.
Yeah, certainly. And I'm referring to disinflation as a change in the pace of the increase. So
right.
Versus deflation, which would be the prices actually falling.
That's a good clarification. Disinflation is a slowing of the pace. Deflation is what we wouldn't want. So Brad, correct. Good point. Deflation is what would be a bad sign.
Just last.
Disinflation is actually more positive.
Certainly. And so where inflation has been stickiest here, and I want to end on this point because we've seen a lot of planning around shelter here. Where are you anticipating and where are you recommending to your clients that are looking across what to do with their home, where to purchase a new home, and how to get the most equity out of their home? How are you advising clients in this climate right now?
Yeah, and the rising housing prices, like you say, has been one of the most pervasive places where we've seen rising costs. Housing costs have certainly continued to rise. We mentioned risk management costs. The cost of home insurance has jumped 30% over the last since 2020. So this is clearly a concern. In terms of planning, equity is an asset. It's part of your plan. However, you have to live somewhere too. So when we're talking to people about how to treat that equity in your retirement plans, it's important to think about where are you going to live? Is that part of your savings, part of your equity? If so, are you going to be downsizing, et cetera? And that's certainly something to keep into account with your planning. There's more and less expensive places in the country. And certainly, thinking through that as part of a comprehensive wealth plan. In terms of the housing market overall, it doesn't seem like there's a major drop on the way. So we're also often talking to people if they're trying to get into the housing market. Saving, planning, all of those things to save the down payment. It isn't easy, but that is certainly one of the areas in the market where we're seeing the most sticky sort of rise in costs.
Certainly. We're going to continue that conversation on the housing front just a little bit later on in the show. Rob, thank you so much for taking the time here with us today. Happy New Year to you. Appreciate it.
Thank you. Happy New Year.
Certainly. Coming up on Wealth, we're breaking down the top housing trends for 2025. But first, a deeper dive into a frequent stock on Yahoo Finance's trending ticker page. MicroStrategy and its chairman, Michael Saylor, are practically synonymous with Bitcoin nowadays, but the business intelligence company has been around since 1989. Beyond the Ticker takes a look at the company's biggest moments.
MicroStrategy and its chairman, Michael Saylor, are practically synonymous with Bitcoin these days. But the business intelligence company has been around since 1989. Back then, it was all about data analytics, and Saylor, fresh out of MIT, was a rising tech star. In 1998, with the dot-com boom well underway, MicroStrategy went public under the familiar MSTR ticker, $12 per share. It rocketed to $333 as the dot-com boom peaked. Saylor became a paper billionaire practically overnight and wasn't afraid to spend his wealth on legendary parties and a yacht, capturing the flashy spirit of the era. But when the bubble burst in 2000, MicroStrategy's stock plummeted to just 42 cents, a stunning 99.9% drop. The company had to restate its financials, and the SEC slapped the company with fines. Still, he held on, shifting MicroStrategy's focus back to enterprise software and slowly dug the company out of its hole. By 2010, MicroStrategy was moving into mobile analytics, and Saylor wrote a prescient book about the coming smartphone revolution called The Mobile Wave. But in 2014, facing stiff competition, MicroStrategy laid off more than 700 workers, and Saylor cut his own salary to just $1. The pandemic, however, would bring new opportunities. Saylor pivoted MicroStrategy again, this time to Bitcoin, arguing that it was a better store of value than cash. He poured billions of corporate dollars into it, and today MicroStrategy holds around 439,000 Bitcoin with an average purchase price of just over $60,000. With Bitcoin trading around 100 grand per coin, MicroStrategy's crypto stash is now worth $44 billion. Investors, however, are placing a significant premium on the company, pushing its market capitalization to $89 billion, enough to secure its admission to the Nasdaq 100 index on December 23rd, replacing Supermicrocomputer.
Mortgage rates for the week ending January 2nd are out. Yahoo Finance's Claire Boston joins me now with the numbers. Hey, Claire, what do we know?
Hey, Brad. So this week, the 30-year mortgage rate is at 6.91%. That's up from 6.85% last week. 15-year mortgage rates also rose to 6.13% versus 6%. So that is the third straight week of gains. And we are starting 2025 on a bit of a sour note for people in the market. Historically, when we see mortgage rates headed towards 7%, that's when the housing market usually really slows down because affordability is just so hard for many of those buyers.
And so as we're taking a look through some of this data, we also have a comment from Freddie Mac's chief economist saying, compared to this time last year, rates are elevated and the market's affordability headwinds persist. We've been seeing mortgage rates tick higher. So what does this mean as well for supply as we should be thinking about that, Claire?
Right. It's quite interesting. We actually have seen inventory improve. And so that is a sign that maybe buyers and sellers are getting used to this higher rate environment. However, one thing that I found really interesting is that there was a recent Redfin report that suggested that a lot of what's on the market right now has been on the market for over 60 days. So basically it's stale. And what a lot of buyers are saying is that it's too expensive. And so it seems like there's a little bit of a mismatch in between buyers and sellers in terms of pricing. And I'll be quite interested to see where things go from here, just given that affordability is a really big challenge right now.
Yeah, affordability, pending home sales might also be another key figure to track here going forward. This is another part of the comment from Freddie Mac's chief economist. Buyers appear to be more inclined to get off the sidelines as pending home sales rise. So we'll see exactly where the mindset of the potential home buyers prevail going into 2025 here. Claire, thanks so much for helping us break down the numbers.
Thank you.
After a sluggish 2024, my next guest expects persistent challenges to weigh on the housing market in the new year, particularly among luxury. Joining me now, we've got Jenna Stauffer, who is Sotheby's International Realty Global Real Estate Advisor. Jenna, great to have you here in studio with us. Let's start with your 2025 outlook. What are you anticipating here?
So it's going to be another sluggish housing market, in my opinion. In 2024, the housing market, it was really driven by a lot of challenges. We had affordability constraints, we had inventory constraints. These inventory constraints are going to stick around in 2025. One thing that I do predict that's going to happen in 2025, and what we're already seeing now, we're seeing inventory levels start to pick up. So what's happening with inventory levels, they're actually up around 12% from where they were last year at this time. And what this means is that we're going to start seeing some downward pressure on home prices. We're going to see deceleration. So the latest Case-Shiller read just came out. It showed that prices were up around 3.6%. Now, if you look at March, that number was around 6.5%. So you're seeing that more modest pace of appreciation. And I think that that's something that we're really going to see in 2025.
Okay, so if buying a home was on my 2025 to-do list, on my vision board, what's some advice that you would give me, my friends, who have all been talking about buying a home?
Well, don't give up on the dream of buying a home.
Don't stop believing.
Yeah, that's right. That's right. Look, I think that's something for home buyers to take into 2025. You have to understand that with inventory levels picking up and with that downward pressure on home prices, there's some opportunities out there. So there's some sellers that still have priced their homes according to maybe prices that we were seeing more back in 2022. And now they're going to have to adjust their expectations. And I think if their homes are staying on the market for quite a while, which is something that we're seeing more stale inventory, more homes sitting longer on the market. These are areas where buyers can really get into. There are opportunities for buyers.
And you mentioned something that we're going to come back to, which is these stale listings. But while we're thinking about this, the mental checklist that sellers should be working through as they're looking to list their home and put their home on the market.
Sellers have to price correctly in this market. Again, as I've just been speaking about, with inventory levels picking up, things have shifted. And because buyers have so many affordability constraints, obviously that slows down demand. So what a seller must do is they really have to know their market. They have to know their value. You've got to price it right, or else your home is going to sit on the market.
Jenna, you're an agent in Key West, Florida. We were just talking about in the break how warm it is probably down there, how cold it is up here. What housing trends are you observing in your own market right now?
So I'm seeing exactly what we're seeing on a national level, something that we're seeing in the Keys where I'm based. We're seeing our inventory levels pick up, and that has slowed some sales. We're seeing affordability constraints, of course, in my market. We're seeing insurance challenges. I would say that my market's really driven by insurance challenges, inventory challenges, of course, inflation. You can kind of say it's all these I's, right? That's what's driving my market in the Keys.
And so as we're thinking about it, and we were just discussing this a moment ago, I wanted to come back to it, stale listings that are on the market. And this is usually identified by homes that are typically on the market or listed and are perhaps not getting bids that come online. Perhaps they're priced inappropriately. And so they stay listed for longer, and we see them exceeding what is typically the average here. What are you seeing in listings right now, and how they're being bid into, where the buyers are coming from, and the entire dynamic right there, especially as that staleness has started to become a little bit more of the mode right now across markets too?
Well, there's a lot of pent-up demand from buyers. So you've had a lot of buyers. You have to look back on these past 2 years that they've been waiting for something to happen in the market, right? They've been waiting for prices to drop. They've been waiting for interest rates to drop. They've been waiting for that perfect moment. Well, now I think buyers are accepting current conditions. So these are the people that are buying. They're the ones who have had this pent-up demand, and they're kind of saying, you know what, enough is enough. I'm going to make a move. I'm going to try to get into the housing market. So these are some of the buyers that we're definitely seeing in the market right now.
What do you make of the generational dynamic? Because even as I'm kind of scanning through the analysis from multiple home, the inputs of data that exist, whether it's a larger firm or whether it's some of the agents out there, it seems like there's this dynamic among some of the baby boomer generation that might be sitting on a lot of the single family homes that might not even need that much space, but are also unwilling to list as of right now. I wonder what you make among some of the generational dynamics that you're seeing play out, especially as millennials are looking to get into many of those homes too.
Well, a lot of these baby boomers, why they're not selling is because they're probably locked into a very low mortgage rate right now. So remember, mortgage holders right now, you have around 60% of them, they have a rate under 4%. You have 23% of mortgage holders that have a rate under 3%. Nobody's really incentivized to let go of that mortgage rate and then enter a very challenging housing market, a very expensive housing market that was also driven by inventory constraints, so there wasn't a lot to choose from. So I believe that's why a lot of these baby boomers are staying put. And what this has really done too, what we've witnessed in the housing market is created such a divide between the haves, the have-nots, right? It's really worsened income inequality. Now on the flip side though, you'll have people that are shut out of the market, but you're still having these individuals that have been able to really reap substantial gains in the housing market. And those will be the people that will be purchasing homes and also making moves in 2025.
All right, I took a look at some of your listings before the show. I got to save up just a little bit more to be in that ballpark here. Jenna, thanks so much for taking the time here. Appreciate it.
Thank you very much, Brad.
Absolutely. Coming up, everyone, your Yahoo Finance market update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
Focus on the trends, focus on those earnings reports. We're seeing earnings growth. Block out the noise.
Don't let emotions drive your investment decisions. Really important. Things like FOMO, you want to try to avoid that.
We're still bullish on stocks and would suggest to stay invested.
Pay attention to both their equity portfolios and their fixed income portfolios. Constantly reevaluate, are trades working, what's good out there, what should they be involved in.
Don't make any outsized bets based on potential policy or based on anything specifically coming out from Washington. Having a disciplined process over time across asset classes, within asset classes is really important.
One thing we think is incredibly important in 2025 is that investors do not become too complacent. There has been a lot of optimism, a lot of good news heading into this year, but we don't want to turn a blind eye to potential risks that are out there.
We're 2 hours into the trading day, and it's time for Yahoo Finance's Market Minute. Stocks looking to snap 5 consecutive days of losses, with the Nasdaq leading gains boosted by Nvidia shares. General Motors' fourth quarter sales rose 21% from the year earlier. Sales of its electric vehicles jumping 50% for the quarter and 125% for the year. And Rivian stock surging after beating the street's expectations for fourth quarter deliveries. The strong quarter helped the EV maker meet its full-year delivery goal in 2024. Plus, Adobe's price target lowered at UBS as analysts note fierce competition in the creative AI space. And that's your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the day. More wealth when we come back.
Food prices coming down in December thanks to cheaper sugar, dairy products, and vegetable oils, according to a new report from the UN. Still, prices remain near 19-month highs overall, and some staples are near records, including breakfast favorites, coffee, and orange juice. Joining me now, Ricky Volpe, who is the former USDA economist and Cal Poly professor of agribusiness. Great to have you back on the program. Let's start with food overall. Average prices for food at home rose in November by the largest annual pace in a year. Where, to your best estimation, do you believe that they'll continue to move from here?
I do think that they will continue to trend up, and that is the normal pace of things. And it's also worth pointing out that the pace of inflation has picked up from the projections that we were running, or that the USDA was running earlier in the year. So we're still on track for food price inflation to come in lower than normal. We're used to grocery prices increasing maybe 2.5% per year. That's about the average over the last 20 years. We're looking to come in under that. There was a period of time where we were looking at maybe flat food prices in 2025, but there are a few problem spots that I'm sure we'll talk about today, which are pushing that up. So we're looking at maybe a point and a half at 2025 right now, assuming no more unpleasant surprises.
Certainly. Want to give folks some actionable tips before we get to those problem areas as well here. What are some actionable tips? How can consumers save money, even if we do continue to see some moderate and slightly below average food price inflation in 2025?
Well, so right now, the real problem spots, or most of the real problem spots, have to do with meat, dairy, and eggs, even though we have seen that recent dip in dairy prices like you mentioned. But that's where we're still seeing the strongest price inflation. Those are the only categories where we're seeing food price inflation sort of beating that historical average. So if consumers are sort of willing to ride out the storm and sort of go light on those foods for the next few months, that's going to be one way to sort of see their grocery bill stay flat or even come down a little bit in the coming year. And it's still the case, regardless of what, may be coming out in some other media sources that I've seen, it is still the case that it is cheaper to purchase food and prepare it and consume it at home. It is not the case that eating away from home has become cheaper than eating at home. In fact, it's quite the opposite. And food price inflation for restaurant foods, even fast food, is still way above normal. And finally, I would just say, I think I say this every time you have me on, private labels, store brands, they are still an actionable way for consumers to save an easy 15-20% across the board in most spending categories.
Yeah, and so Ricky, with all of this in mind, some of the challenges that we've seen over the past couple of years, I mean, we've had egg CEOs on talking about the avian flu multiple times over, and now how that continues to trickle and play out through the prices in eggs, and how that was at least one of perhaps the thought processes that some consumers were thinking about going into the election. So even post-election now, and now in 2025, where is that ranking among the priority for consumers, and what are they set to continue to see, as it doesn't seem like the avian flu has just gone away and vanished?
No, eggs have been hit harder than any other supply chain in all of food, maybe in all consumer spending in the last couple of years. We've seen egg prices flirt with all-time record highs. And, it's important for me to stress, when I say that food prices have reached record highs, I mean adjusting for inflation. So it's common to see headlines that say, food prices are at record highs. Usually people are talking about nominal prices, the sticker prices that you see in the store. Mm-hmm. But even controlling for the value of the US dollar, eggs were cheaper in the 70s and 80s when we had runaway food price inflation. So eggs, and just in general, that whole chicken, poultry, broiler, egg-laying hen supply chain, really problematic. And we sort of keep on seeing, like you said, these CEOs and these executives coming out and saying, well, if avian flu cools off, then we should see a return to normal. And that's true, because it's such an elastic supply chain. These animals, these chickens, they only take 5-6 weeks until they're market ready, or they're producing eggs every day. And that's the good news. But the bad news is that avian flu just sort of keeps on popping up. I mean, it's an overdone analogy, but it's kind of like whack-a-mole. The industry has gotten much better at sort of targeting and identifying these breakouts, and sort of eliminating the minimum amount of inventory to contain and prevent the spread. But it keeps on popping up in all the major egg-producing states in the U.S.
Yeah, Ricky, this gets to something else too, and if I'm thinking even about the point of origination, as we're talking about the avian flu, we've talked for decades now, it seems like, how much climate change could impact the spread of viruses or illnesses that also impacts livestock, that impacts the food that we eat as well, and considerations for sourcing and harvesting there. How does that play into other categories that could continue to be impacted at the kitchen table?
Yeah, I mean, climate change either is or should be at the forefront of the concerns for, pretty much every major decision maker in the food supply chain. I will say the industry is adapting. The industry is adapting, and is adapting quickly. Is it going to adapt to the point where, we're going to see sort of improvements before we see things get worse. I'm not sold on that. But I will say we're seeing some really, really promising trends in all of the food industry in terms of renewable energies and using controlled environment agriculture, which sort of, protects crops and animals from the vagaries of weather and extreme weather events and all of that. So we're seeing some really important changes in sourcing, changing in how things are grown and where they're grown, reducing the burden on transportation, because when we talk about eggs and dairy and those products, what's being under discussed in my view is the role of truck transportation, because these are such transportation heavy categories where they're heavy and they require temperature control and they have to be moved as quickly as possible, and we're having major issues with truck shortages. So it's not necessarily climate change, but seeing technological advances in terms of automated trucks and so on and so forth. So these things are happening. In many cases they're being implemented. I'm of the opinion that we're going to see the road get bumpier before it smooths out, but by and large I think the industry is aware of this and is working to sort of get ahead of it and protect the supply chain from the impacts of the changing weather and warming temperatures.
Ricky, definitely want to check back in the future. Thanks for hopping on the program with us again. Always great to get some insights.
Thank you.
Thanks.
Bye-bye.
Let's get a check on the markets. As of right now, we're just a little 2 hours into today's trading activity and taking a look at the Dow Jones Industrial Average. We've added on to some of the gains that we saw at the beginning of today's trading session, where we were up by about 0.5%. Right now, we've added on just a smidge there, if you will. We're up by about 0.6%, but not quite at today's intraday session highs that happened within about the first 30 minutes of trade, as you can see there. But taking a look at the Dow, that's up fractionally. The Nasdaq Composite, that's added on to its gains that we saw at the opening cross here. Right now, you're seeing gains of about 1.4% on the day. And the S&P 500 also at some intraday session highs. It's up by about 1% here. Also, I want to take a quick look at some of the sector activity. We started off the day positive across the board. Let me just navigate on over to our 11 S&P 500 sectors here, so you don't have to go load them up at home. We've got them preloaded here for you in our Wi-Fi Interactive. We started off, as I mentioned, the day positive across the board. 11 of the sectors loaded up here for you on the screen, and we're still positive for all 11 sectors, but we've had some change in leadership. Utilities right now, that's moving up by about 1.6%. Technology and some of the consumer discretionary names not too far behind, though, as of right now. We've got much more on wealth after the break, but first, Costco set the precedent for membership-only models back in 1983. What drove success for the more than 40-year-old retailer? Good question, you ask. Beyond the Ticker takes the deep dive into the company's biggest moments.
Costco set the precedent for membership-only models back in 1983. But what led to such success for the more than 40-year-old retailer? Beyond the Ticker takes a deep dive into the company's biggest moments. Back in the 1970s, entrepreneur Sol Price opened the first ever wholesale retailer under the name Price Club in Southern California. In 1983, Jim Sinegal and Jeff Brotman opened the first Costco warehouse location in Seattle, Washington. A year later, the iconic Costco hot dog was introduced. With the fixed price point it still has today, $1.50. In 1985, Costco went public at $10 per share. At the time, the company had 17 locations. In 1993, Price Club and Costco merged. And until 1997, it was called Price Costco, until it took on the name we know it as today, Costco. In the mid-90s, Costco introduced its private label, Kirkland Signature, named after its original headquarters in Kirkland, Washington. That business now worth $56 billion. In 1997, the company launched its e-commerce platform, Costco.com, bringing its low prices and services online. By 2014, Costco was the third largest retailer in the United States, with sales exceeding $110 billion and a net income of over $2 billion. And its presence and loyal membership-only model keeps growing, giving it the ability to raise its membership in 2024 for the first time since 2017, from $60 to $65 per year for 3 of its membership models. As of 2024, there are nearly 137 million members and 891 stores across the globe.
programming note, on this week's episode of Warrior Money, they're going to take a look at what could be the next big driver of the global economy. Quantum computing. CrowdPoint Technologies founder and CEO Sean Brem joins Yahoo Finance's Warrior Money, hosted by Patrick Murphy and Dan Coons, to discuss his own work in quantum innovation. Take a listen.
The world is changing so fast. The country that dominates quantum computing will dominate the global economy for the next 100 years, at least 50 years. And so what investors need to look at is they need to start understanding where quantum is, spend a little bit of time on understanding what it isn't, and then start looking at how to get involved in that environment. Because the chances, let me make it even more simple. It's 1994 already, but I'm not Brian Gumble trying to figure out what the @ symbol means for the internet. And for those of you that remember that, it's going to be the same. Overnight, things are going to change. You know, it's history's repeating itself, and we're blessed. The three of us are blessed enough to be in a position where, you know, like the telegraph got changed by the telephone. Well, we just saw just 30-something years ago the internet come out, and here we are at quantum and all those guys. God, I wish I got into Yahoo Finance back in the day, right? Well, now's your chance, because no matter what, whether you just need to get into quantum, you need to spend some time understanding it. And if you don't, here's the good news. If you don't understand what the current classical systems are, you got a chance to leapfrog ahead and learn a little bit about quantum and not have to worry about going back and reading over again.
And you can catch episodes of Warrior Money Fridays at 12:30 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. We're starting the year looking at the best ways to optimize your retirement, whether you're a young person saving up or you're nearing retirement age and want the best withdrawal strategies. Joining me now, we've got Robert Powell, host of the Decoding Retirement podcast. Bob, great to see you here. Happy New Year. I haven't seen you since the turning of the new year here. So how can we maximize tax efficiency when saving for retirement?
Yeah, so I think if you're lucky enough to have a health savings account at work, start there. It's triple tax advantage. Contributions reduce taxable income. The investments grow tax-free, and withdrawals for qualified medical expenses are tax-free as well. And then the next thing I would think about is look at your 401k. Is it a traditional or a Roth? If you have both options available, think about your tax rates now and what they'll be later. If you're in a low tax bracket now and you'll be in a high tax bracket later, contribute to your Roth first. And if you're a high tax bracket now and a low tax bracket later on, think about contributing to your traditional. The one caveat I would add to that, Brad, is this. Even if you're in a high tax bracket now and the bulk of your retirement money is in a pre-tax 401k, consider the Roth, because what you want to do is have what's called account diversification, money in your pre-tax account, money in your post-tax account, and money in your taxable accounts along the way.
Certainly. So for those approaching retirement, how can they withdraw safely without getting hit by a big tax bill?
Yeah, so this is a great question. Again, you have to be strategic about it. You have to think about your tax rates, not only now, but what they'll be over the course of your retirement. The traditional rule of thumb, Brad, is that you would take money from your taxable accounts first, then from your traditional pre-tax accounts like a 401k or an IRA, and then lastly from your post-tax account, your Roth IRA. And then along the way, if you have the opportunity, if the bulk of your money is, say, in a IRA, traditional IRA, start thinking about doing Roth conversions, because what you want to do is remove the taxable income from later in your retirement years when you could be pushed up into the 24% bracket or even higher. And then the last thing I'll mention, I mentioned taxable accounts. Married couples filing jointly can now realize up to $94,050 in long-term capital gains in this new year and pay no federal income tax on those gains. And that strategy can help, instead of tapping your Roth IRA account, it allows that Roth IRA to continue growing tax-free.
Really interesting. Bob, great retirement updates there. We appreciate it. And you can get much more of Bob on the Decoding Retirement podcast every Tuesday, 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. Let's do a quick check of the markets here as we're taking a look at the Dow, the S&P 500, and the Nasdaq. You've got green across the screen right now. The Nasdaq in the ballpark of some of those intraday highs that we've been tracking here this hour, up by about 1.5%. The S&P 500 also adding on 1% on the day. That's up by about 1.1%. And the Dow Jones Industrial Average, fractional gains there. You're seeing that in the green by 0.6%. That does it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You could stay tuned for Market Domination with Julie Hyman and Josh Lipton. Guess what? That comes up 3 p.m. Eastern Time. They will count you down to and through the market close. You don't want to miss it.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.